Namaskar friends, welcome to the channel JIV and CIV Made Simple. If you are looking to revise all the important modules of CTP, that is Certified Treasury Professional, then you are at the right place, because in this video we are going to revise from module A to module G all the important points, bullet points in just 3 hours, so that you can go through the entire concept once, and after that 60% of the paper is theoretical paper, so that 60% will be taken care of from this particular session, and the remaining 40% which is numerical aspect, so formula I will provide in this session, but you need to practice on that part. So 60% or let's say 70% will be taken care by this particular video. So I request you to watch the video till the end, and if you are looking for a study material for the same, you can WhatsApp me on the number shown on the screen, or in the description section you will see the link. So let's get started with our module number G. We are moving in the reverse order depending on the weightage of the module. Higher weightage we will cover first, and then lower weightage if we cover last. If you want to cover a particular module, see the time stamp in the description section. I have provided the time stamp conduct for stakeholder. So this is the rule book that ensures that our financial market stay fair and it stay the transparent. So first comes integrity. So integrity means a broker should always be honest, fair and on time while dealing with clients or the market. No false promise, no shady shortcuts. That is called integrity. Then comes prudence. Prudence means every action should be taken with care, skill and proper judgment. In simple word, a broker must think smartly before making any move. Third point is no manipulation, which means a broker should never try to mislead investor or manipulate market price through fake news or false information. No malpractice, which means avoiding things like artificially increasing share price or creating unnecessary hype just to benefit a few people. And lastly, legal compliance. So every broker must strictly follow SEBI rule, exchange guideline and all the relevant law. So in short, we can say SEBI message is very simple. Be ethical, protect investor and keep the market clean and transparent. Now, so that is the point. Now SEBI code of conduct, responsibility toward investor. So let's understand the SEBI code of conduct. Every stockbroker has a simple rule to follow. The investor come first, right? So let's break it down. First of all, order execution. So a broker must execute every client order accurately and at the best possible market price. Whether it is a small investor or a big one, everyone deserves equal treatment. No favoritism is allowed. Next we have is timely communication, which means once the order is placed, the broker should update the client quickly about its status and make sure that payment or delivery of security happen without any delay. That is called timely communication. Third, then comes contract notes. What does it mean, contract notes? So after each transaction, the broker must send a contract note immediately, and it is sent in the standard exchange format that keeps everything transparent and traceable. Then we have confidentiality. Confidentiality is equally important. A broker must protect client data and never share or misuse it for personal gain. And finally, ethical practice. So every dealing must reflect fairness, honesty and integrity. In short, we can say that SEBI expect broker to serve every investor with fairness, keep communication transparent, maintain confidentiality and always follow the ethical practice. Now friends, let's look at the additional responsibility of a stockbroker under the SEBI code of conduct. Right, so basically this part focus on the ethical trading and client protection. First of all, no excessive trading. So a broker should never make unnecessary buy-sell transaction just to earn extra brokerage. Every trade should be in the best interest of the client, not the broker, not the broker's pocket. Next, no misleading information, which means giving false tips or wrong advice just to make client trade more. That is a big no under SEBI rule. Honesty in communication is a must. Then comes no dealing with defaulters, which means broker must stay away from client who have defaulted earlier. This helps maintain market discipline and integrity. And also there must be transparency in role. So if a broker is trading on his own as a principal or on the behalf of a client as an agent, it should be clearly informed to the client. If any conflict of interest exists, it must be disclosed upfront. Right, any conflict of interest should be disclosed upfront. Now let's talk about the responsible investment advice. So a broker should recommend investment only after understanding the client financial position, risk capacity, investment goal. Proper background information help ensure the advice is suitable and safe for the client. And finally, we have public media conduct. So if a broker or their employee share investment advice in public, say on TV, social media or newspaper, they must clearly disclose any personal, family or employer interest in those securities. Transparency is key here also. So to summarize, we can say that SEBI expect every broker to act with honesty, fairness and full transparency, no manipulation, no biased advice, just pure client first ethics in every action. Now, SEBI code of conduct for a stockbroker and sub-broker. So friends, this section ensures that both broker and sub-broker act with transparency, honesty, responsibility while dealing with investor. So starting with stockbroker obligation, so every broker must give accurate and timely report to SEBI and the stock exchange. No false reporting, no hiding of fact. Complete honesty is mandatory. Also, broker must sign formal agreement with their client as prescribed by the SEBI. This keep everything clear, documented and ensure accountability on both the sides. Now let's move to the sub-broker. Sub-broker general principle. Just like broker, sub-broker must maintain integrity, which means honesty, fairness, promptness in all the dealing. They should also show the prudence, which means using proper skill, care, judgment while handling any investment activity. So friends, if you are looking for study material for CTP examination in the form of unit-wise MCQs, in the form of such quick revision PDF, in the form of 2000 plus MCQs, in the form of previous year question, then you can enroll in our CTP course. The link of the course is available in the description section, or you can WhatsApp me on this particular number for more detail. Now let's come back to the sub-broker. Sub-broker responsibilities toward investor. A sub-broker must execute client order accurately and at the best possible price while also keeping the client updated on the order status. So they should, the sub-broker should assist the client in getting contract notes from the main broker, right? This keep things transparent. Client confidentiality is crucial. No sharing, no misuse of client data under any circumstance. And of course, ethical conduct must be followed. Means no unnecessary trading just to earn more commission, or no fake or misleading advice to push investor into unwanted trade. Then there are additional SEBI guidelines for sub-broker. What does it say? That a sub-broker can earn a maximum commission of 1.5% of the transaction value. This ensures fair pricing and it prevents the overcharging. Right, please remember, maximum commission of 1.5% of the transaction value. Also remember, sub-broker must not deal with defaulting client, which means this helps maintain integrity and trust in the entire market system. So in short, we can say that SEBI code ensures that both the stockbroker and the sub-broker work with transparency, ethics, a strong behavior, and a strong investor first approach. Now friends, let's talk about the SEBI code of conduct. What are the responsibilities of the sub-broker? So this part focus on how sub-broker should maintain transparency, fairness, professionalism. So a sub-broker must always be clear about their role. They act like an agent, not as the main broker or principal. If there is ever a conflict of interest, like a situation where personal benefit could come in the way of client interest, it must be disclosed immediately. The rule is simple. Client interest comes first always. Next is the responsible investment advice. You know what it means? Before giving any recommendation, a sub-broker must understand the client financial condition, existing holding and investment goal. They should collect the necessary information first and only then suggest what is best for their client. In short, don't just sell, guide responsibly. Moving on to public media ethics. If a sub-broker or their team give investment advice publicly, say on social media, television or any article, they must clearly disclose if they or their family or employed hold any interest in those securities. This ensures full transparency and credibility in their advice. Now the last one, that is called professional competence. A good sub-broker should always have trained staff and efficient system in place to handle client service. This helps in providing quick, fair and complaint assistance to every investor. So to summarize, we can say that SEBI expects sub-broker to act with clarity, skill and complete honesty. Their advice must be client-focused, conflict-free and backed by professional excellence at every step. Now friends, let's switch our focus to how sub-broker should maintain discipline, honesty, cooperation while dealing with broker, client and regulator. Starting with relationship with a stockbroker. A sub-broker must work closely with the main broker to make sure that every transaction goes smoothly. If any trade remains unmatched or if any trade has issue, they should resolve it quickly and avoid using invalid document. If there is a bad delivery, it must be replaced promptly without any delay. They must also protect the client interest. Very, very important. Client interest has to be protected, ensuring that client receive all the rightful benefit like dividend, like bonus share or right shares on time. Then we have reliability. Reliability is the key. Settlement must be done on time and business liability should be met responsibly without negligence. And very important that there must be tripartite agreement. What does it mean? It is a kind of formal contract between the client, sub-broker and the main broker. It ensures clarity, accountability, transparency in every dealing. Next comes ethical business practice. Sub-broker cannot advertise or promote their business publicly without the exchange approval. Also, they must not use unethical tactics to steal or to attract client from other broker. Fair competition is the rule. Then we have conduct toward regulatory authority. Every sub-broker must maintain discipline and proper behavior on the exchange. No aggressive, no disruptive, no improper conduct. They must also strictly follow all the rules, all the bylaws and regulation issued by the exchange and the SEBI. Moving on to regulatory reporting duties. Sub-broker must provide all the required document, returns, correspondence to SEBI or the exchange on time. Every report must be accurate, truthful and complete. Submitting false information is strictly prohibited. And of course, no manipulation. They must stay away from any fraudulent, misleading or compliance at all the time. Right. So this is what we have learned. Now let's talk about the FIMDA. So friends, let's talk about the FIMDA Code of Fair Practice. This is also often called the CFP. In short, we call it CFP, which is a key framework that set the standard for how financial institution should behave in the debt market. CFP. First of all, let's understand its essence and objective. The main goal of this code, that is FIMDA Code of Fair Practice, CFP, right? The main goal of this code is to promote professionalism, ethics, and efficiency in the way debt market participants operate. It aims to make sure that every transaction is carried out with transparency, fairness, and integrity. It also focuses on risk control, protecting confidential information, and most importantly, maintaining trust in the market. Let's look at the core pillar of the Code of Fair Practice, also called CFP. First code is the integrity, which means every participant must act with honesty, accountability, and strong ethics. In simple terms, do the right thing even when no one is watching. That is called integrity. Governance means what? Following the clear and fair rule that apply equally to everyone in the market. No shortcuts, no special treatment. Transparency, which means all the dealings should be open and clearly communicated with accurate and complete information, because trust is built only when things are clear. Then execution excellence, which means every trade, every deal should be done with accuracy, speed and professionalism. It is about doing your job right, on time, without any error. So in short, we can say FIMDA Code of Fair Practice set the gold standard for how the debt market should function, with ethics, transparency and discipline at its core. It ensures that the financial institution not only follow rules but also build lasting trust and confidence in the system. Now let's understand the scope and applicability of the FIMDA Code of Fair Practice or CFP. To begin with, this code applies to all the transactions carried out by the FIMDA member. Right. The idea is to ensure that everyone follow the same ethical and professional standard, creating a level playing field in the financial market. Now here is the interesting part. It's not limited only to member, right? It's not limited only to member. Non-member like corporate, basically mutual fund, pension fund, individual, right? They are also encouraged to follow this same principle. Why? Because when everyone follow the same fair practice, it helps build a harmonized, transparent and ethical market culture. The code mainly covered the fixed income, money and derivative market, right? It covered these things: fixed income, money as well as the derivative market, right? Area where trust, transparency and professionalism matter the most. Now let's talk about the extended applicability. Even though this framework is designed in India, its core principles are universal. They can be easily be applied to international transactions as well. This promotes a sense of global consistency, right? Ensuring that Indian institutions align with the international best practices. What is more, the code is quite flexible, right? This code is quite flexible, which means Basically flexibility, which means it can adapt to new product or evolving market situation, making it always relevant and practical. So to summarize, we can say that FIMDA Code of Fair Practice, or we call it CFP, it helped create a unified, transparent, ethical financial environment, not just within India but even across the global market. Right, I hope this is crystal clear right now. Now let's talk about the derivative scope and core principle. So basically let's explore the FIMDA CFP, or Code of Fair Practice in the context of derivative. Right. So the code cover a wide range of product like interest rate swap, forward rate agreement, interest rate future, credit default swap. Basically all major instruments used in the debt and derivative market. When it comes to foreign currency derivative, right, so such as suppose we have a cross currency swap, option or future, these are foreign currency derivative, right. The transaction should follow the FIDE convention, right, which are the standard rule for foreign exchange dealing in India. The best part is that the code is quite flexible, the code is quite future ready. It does not apply to the current instrument, it covers all the fixed income and derivative product, right. It encompasses all the fixed income product as well as the derivative product, right, whether existing or newly introduced. It ensures adaptability and inclusiveness in the system. Let's talk about the guidance for the market participants. Please understand that everyone involved in the market must understand, right, everyone who are involved in the market, they must understand and align themselves with the principle of this code. If there is ever any confusion, they should seek clarification from the higher management rather than making assumption. It is important to note that this code acts like a framework, not a detailed rule book. That means institutions are free to add their own internal ethical or procedural standard to strengthen the good practice further. Now friends, core pillar, professional and personal ethics. So the first thing is integrity. Integrity means every participant must maintain the highest level of ethics, honesty and professionalism. Regulatory compliance. The FIMDA Code of Fair Practice ensures that every player in the derivative and fixed income market act with ethics, compliance and adaptability. In short, we can say that the FIMDA CFP ensures that every player in the derivative and fixed income market act with ethics, compliance and adaptability. Now, then we have personal and professional ethics. So, all market participants must follow established dealing procedure to ensure consistency, accountability and reliability in every transaction. They should also uphold integrity and professionalism. If you look at the governance principle, so good governance is the backbone of trust. Firm must maintain high corporate governance standard to ensure responsible participation in the market. Staff must be skilled, they must be trained, they must fully aware of the regulation so that they can serve client and the market professionally. Commitment must be honored. The mantra is very simple: my word is my bond. A strong control and procedure should be in place according to the FIMDA guideline, and there must be clear policy to address any unethical behavior immediately. Let's talk about the communication, channels and transparency. All communication must happen through authorized, approved channel only. It ensures security, compliance and reliability. Right. Additionally, communication should be transparent, clear and honest with all stakeholders, leaving no room for confusion or misrepresentation. In short, we can say the FIMDA Code of Fair Practice ensures ethical dealing, robust governance, skilled personnel, transparent communication, which together build trust and efficiency across India's fixed income, money and derivative market. Now let's talk about the communication and execution standards. So basically, these standards are all about professionalism, transparency, fairness in the market interaction. Starting with communication standard, every interaction in the market must be clear, accurate and professional. Sensitive client or market information must always be kept confidential, right? Sharing externally is allowed only with proper approval. Now, access to price sensitive or identifiable information should be, strictly limited. When discussing the market, stick to the general trend and never disclose confidential detail. Never spread false or misleading information. Honesty is non-negotiable. Then, all the media interaction must go through designated source to maintain accountability. Finally, regulatory or committee members, they must never trade. They must never share material non-public information. This prevent unfair advantage. Now moving on to execution standards. Every transaction must be executed fairly and promptly, respecting the order in which the requests are received. Negotiation and dealing should be transparent, honest and clear. Right? And client must receive accurate and timely information so that they can make well-informed investment decision. So to summarize, we can say that CFP ensure that every participant maintain professional and transparent communication and they execute trade fairly and efficiently, protecting the client interest, market integrity and a smooth operation. Now let's look at the execution standard under the FIMDA, that is called under the FIMDA CFP. This is about ensuring fair, responsible and trustworthy market behavior. So no misleading trading signal. Trader must never create false impression of supply and demand by doing simultaneous off-market buy and sell transaction. Then next point is prevent price manipulation. Prices, especially of less frequently traded security, should never be manipulated, particularly near the market closing. No collusive transaction. Deals should genuinely transfer market risk or benefit. Any transaction done just to create appearance is strictly prohibited. Then we have the banned routine deals. Buying on behalf of third party without real fund with pre-agreed resale price is forbidden. Genuine bids and offer. All the offer must be within the market range and placed with a real intent to trade, ensuring pricing integrity. Then risk management and compliance. Every firm must have internal framework and control to ensure consistent adherence to this market conduct standard. So in short, we can say the CFP finalized execution standard to enforce authentic trading, prevent manipulation and maintain strong compliance, guaranteeing fair, reliable and trustworthy market operation. Now let's talk about the business ethics. It is the key principle that guide how company and leader make moral and responsible decision. Starting with the essence. So business ethics is all about acting with integrity and making choices that are morally right, especially when facing complex or challenging business situation. Let's look at the key area of the ethical concern. The first one is the finance and accounting. Ethical issues here include manipulative accounting, insider trading, security fraud, and giving or taking unethical facilitation payment. The focus is on honesty and transparency in financial reporting. Next, we have human resource management, which includes fair treatment of employee, right? It includes fair treatment of employee, avoiding discrimination, exploitative labor, workplace harassment, excessive pay inequality, improper surveillance, right? Protecting whistleblower, ensuring safety, and respecting unions. These are all very much critical. Sales and marketing. So ethics in marketing means no misleading claim, no deceptive advertising or targeting vulnerable audience unfairly. Price manipulation and exploitative marketing tactics are also prohibited. Then we have application and leadership. So business should use ethical framework, clear moral principle, analytical method to guide decision making. Beware of ethical lapse which often arise from greed, opaque financial instrument, lack of independent judgment or subtle corruption. These are the kinds of ethical lapses. And leadership matter a lot. Leader must act like a role model, setting ethical standard for the entire organization. So we can say that business ethics ensure integrity, fairness, principled decision making. It helps build trust, responsible leadership and healthy organization culture across all domains, from finance and HR to marketing. Now friends, let's explore the leadership and value system, a critical aspect of ethical and effective management. Starting with the core principle. So value driven leadership means that leader base their decision and action on a strong ethical value and principle. So this approach not only drive sustainable corporate success but also strengthen the organization ethical resilience. Good leadership goes beyond profit, right? So it considered not just financial outcome but also human, social, environmental and transformative goals, making the organization a positive force in the society. Let's discuss some ethical challenges in the organization. First one is the worker alienation. Repetitive or monotonous tasks, this can lead to employee disengagement and loss of motivation. Then we have oppressive authority. Excessive hierarchical power, they may create a perception of suppression among the staff. Managerial pressure, high responsibility or tight deadline, this can lead manager into ethical dilemma, forcing difficult decision. Power dynamic, which means ambition and career advancement. They may tempt someone to use manipulative tactics. Then we have workplace safety. So unsafe conditions pose both health and ethical concern for the employee. Lack of fair processes. Staff in non-unionized setting may face limited procedural protection. In short, we can say ethical leadership is all about balancing value, people, and purpose. It ensures trust, fairness, and sustainable growth. Then we have ethical management and organization alignment. Let's talk about it. Let's explore it, which is a key concept for building a trustworthy and high integrity organization. So if we start with the organization alignment, it is important to harmonize the company structure, task, strategy, stakeholder need to achieve overall success. But here is the catch, that high performance pressure can sometimes push employee toward unethical behavior. So how to prevent it? Through training, through open communication, through collaborative culture, organization can mitigate the risk. And don't forget to recognize and reward the ethical decision or ethical action, not just monetary or performance achievement. This encourages a culture of integrity. Let's talk about the conflict of interest. This arises when personal interests clash with the organization goal, which can bias decision and weaken independent judgment. Leaders and employees, they must be vigilant to identify and manage such conflict responsibly. Now, some core ethical principles they have mentioned: respect for autonomy, which means honor others' self-governance, support and empower them, and always uphold truthfulness and promise keeping. Then we have beneficence. Act in a way that promote well-being and prevent harm. Sometimes this may require balancing it against autonomy. Non-maleficence, which means do not harm and proactively avoid action that could negatively impact others. Justice, which means ensure fairness, equity, impartiality, balance right and responsibility to foster equality within the organization. In short, we can say that ethical management combines organization alignment, fairness, principled decision making. It creates a responsible, trustworthy, high integrity workplace. If we talk about the ethical dilemma, think about it. So basically this is a situation that challenges our sense of right and wrong in business and personal decision making. So let's start with the nature of ethical dilemma. These dilemma arise when there is a conflict between what is morally right and what is convenient or beneficial. Sometimes following one ethical principle may violate other, creating a moral paradox. And often there is an uncertainty about what is the right course of action really is. Then comes complexities of ethical choices. Every decision involves evaluating obligation, responsibilities and competing priorities. Some dilemmas are straightforward, clear-cut right versus wrong choice. Others are very complex, right? When two or more morally valid options exist, each with pros and cons. Regardless, every dilemma requires careful and ethically sound resolution. So how to address this ethical dilemma? So first of all, we have to navigate the ambiguity. Use a strong ethical judgment when right and wrong are not obvious. Balanced decision making. So consider all equally compelling arguments to reach a fair outcome. And choosing between the different options. Sometimes you must make a decision between two morally challenging alternatives. Now, what are the sources of this ethical dilemma? Where do this dilemma come from? First one is the personal integrity lapse, when individuals compromise their value. Second is the conflict between individual value and the organization value, when your goal clashes with your company. And third is the tension between corporate objective and societal value, which means when profit motive conflict with the ethical or social responsibility. In short, we can say that ethical dilemma basically arise from conflicting principle, ambiguous situation and competing interest. Resolving them require thoughtful judgment, moral reasoning, principled decision making, ensure fairness and integrity in every choice. Now let's shift our focus to the standards of integrity in the financial market conduct, which is a key guide to build trust and efficiency in the financial market. Starting with the core principle, the first one is the exemplary conduct, which means market participant must uphold the highest ethical standard, ensuring trust and a strong market reputation. Second is the authorized representation. Every representation should act within their defined limit of authority. No overstepping. Binding commitment. Commitment are sacred. Remember the principle, my word is my bond. Then we have comprehensive training, which means staff must be fully trained in rules, regulations, conventions, market practice to operate professionally. Then we have regulatory compliance. So stay informed and ensure full adherence to evolving market regulation. Then we have the operational standards. So timely trade reporting, which means all trade outside NDS must be recorded within 15 months, right? 15 minutes, ensuring accuracy and transparency. That is called, all the trade outside NDS must be reported within 15 minutes. Then we have the broker's role. Brokers should facilitate transaction without acting as a principal unless explicitly declared. Then we have confidentiality. All transaction related information must be safeguarded, protecting client and market interest. Then we have the market convention. Settlement procedure must follow FIMDA standard covering fixed income, money market and rupee derivative. So in short, we can say, maintaining integrity in the financial market is about ethical behavior, regulatory compliance, confidentiality and disciplined operation. Now, let's talk about the integrity standards in the financial market conduct. So first of all, example, I think we have discussed this, right? This is the repetition of the part. Now, guiding principle of the FX Global Code. So friends, let's now explore the guiding principle of the Foreign Exchange Global Code, which is like a global benchmark for ethical and efficient conduct in the foreign exchange market. Starting with the purpose and scope. So this FX Global Code provide a universal framework of best practices to ensure integrity, fairness and efficiency in the wholesale forex exchange market. It was developed collaboratively by central bank and market participants from over 20 jurisdictions. The Global Foreign Exchange Committee, which is called GFXC, they maintain and update the code to keep it relevant in the evolving market condition. If you look at the core objective of it, so this GFXC code aims to promote a robust, equitable, liquid, transparent, open forex exchange market. It helps participants trade confidently at competitive price, relying on accessible information and ethical conduct. Then we have the structural framework. It is built on 6 pillars. What are the 6 pillars? Ethics, governance, execution, information sharing, risk management and compliance, and confirmation and settlement. And these are the 6 pillars. And these pillars are, detailed in 55 principles, guiding proper market behavior and as well as the decision making. Finally, the complementary role. This code is non-binding, meaning that it supplements the local law and regulation. It enhances global best practices and market integrity without replacing the legal requirement. In short, we can say that FX Global Code ensure ethical, transparent and efficient foreign exchange market. Now let's shift our focus to one of the most important numerical topic from where numerical questions are asked, which is the time value of money. So which is one of the most important concept in finance. Starting with the core concept, that the basic idea is very simple. Money today is worth more than same amount in the future. Why? Because the money you have now, they can generate return immediately, making it intrinsically more valuable. Next comes the growth and opportunity. Basically compounding advantage. Your money earn interest not only on the principal but also on the previously earned return, which accelerate growth over the time. Then we have the opportunity cost. If you receive money later, you lose out on potential earning you could have made in the meantime. Next, consider the inflation impact. Idle money loses purchasing power over the time. What rupees 10,000 buy today may buy much less in the future. If you look at practically, one example they have given you. Imagine having 10,000 rupees today versus 10,000 rupees after a year later. Having it today is better because you can invest it and earn return immediately. Finally, the mathematical foundation. The formula to calculate the present value or the future value is very simple. Just take the principal multiplied by 1 plus rate to the power time. This considers the initial sum, expected return rate and time duration. In short, money has time dependent value. Receiving it earlier enable growth, compound returns and protect against inflation loss, making timing critical in financial decision. Now let's dive deeper into the time value of money calculation. First of all, the core variable that we need to know. PV, which means the present value, the worth of money today. FB means the future value, what money will be worth at the end of the period. I is the interest rate. N is the number of compounding period each in a year. T is the time in a year. The formula is very simple. Future value, which is FB is equal to PV multiplied by 1 plus I by N to the power N into T. Similarly, present value is equal to PV is equal to FB upon 1 plus I by N to the power N into T. So one example they have given you, like you can find the future value, you can find the present value, just apply this formula, right? So remember I and N. What is the I? What is N here? So see, I is the interest rate, N is the number of compounding period in a year, means how many times compounding is being done, and T is the time in the year. Sometimes it is semi-annual, sometimes it is quarterly. So they will specifically mention in the question what is the compounding frequency. Accordingly, you should take the value of n, number of compounding period. T is the time in the year, right? I is the interest rate. Now the question is, what is the impact of compounding frequency? The more often interest is compounded, the higher your future value. As you can see, if we compound quarterly, the future value is 11038. If we compound monthly, the future value increases to 11047. If we compound daily, the future value goes to 11052. So the growth of money depends on rate, time, compounding frequency, as you can clearly see. Delaying receipt of fund increases the opportunity cost, means that you lose potential earning the longer you wait. In short, we can say understanding TVM, right? Understanding TVM calculation help you make a smarter investment decision, plan finance, and optimize the return. Now friends, let's talk about the opportunity cost principle. Money that is not invested loses potential return, reduces its real value over the time. There is a concept of deferred payment. Deferred payment we call it, or delayed receipt we call it. It means you miss chance to earn on that money. That is called deferred payment. For example, suppose 1 lakh received today is more valuable than 1 lakh received 5 years later, because today money can start growing immediately, right? This is the foundation of DCF, that is called discounted cash flow method. Basically, it's all about calculating the present value of future cash flow to assess the true investment worth. DCF, discounted cash flow method. Strategically, this principle is crucial for pension planning, retirement fund, and long-term financial obligation. If you look at the strategic application of TVM, the first one is the financial planning. It helps in scheduling project investment and cash flow efficiently. Optimal decision. It enables you to pick the best investment option by considering money time value. Time adjusted comparison. It ensures fair evaluation of cash flow across different periods. Business analytics. So it helps in evaluating capital outlay versus future inflow to determine the profitability. Regulatory compliance. So it ensures, basically time value of money ensure accurate reporting of financial position over the time. And obviously investor insight is there. It projects future return, retirement balance, investment value accurately. In short, we can say understanding TVM, basically an opportunity cost, it helps you make a smarter financial decision. If you look at the key components of TVM, the first one is the duration, which means the T. How long your investment run, month or year. Interest rate I, which means the annual rate or the discount factor affecting the growth. Third is the principal value, means what your fund are worth today. Recurring payment, which means any regular contribution or any installment you plan to add. Future value, which means what your money is expected to grow into at the end of the period. Then we have the concept of present value versus future value. PV tells you the current value of the future cash flow. For example, 1000 rupees in a year or 2500 rupees monthly for 2 years. And the future value, it projects how much your present fund will grow over the time with interest. Now there are some advanced TVM insight. Compounding. Compounding means you are reinvesting earning so that your money earn on earning, boosting the growth. Compound interest, which means interest is calculated on both principal and previously earned interest, amplifying the wealth. Continuous compounding, which means hypothetical infinite reinvestment during a period, and it has a maximum growth potential. Future value projection, it helps you estimate the future worth of your fund considering the growth rate. Payback period, the time it takes to recover your initial investment, which is very investor such as pension fund, mutual fund, insurance company, and retirees seeking a steady return. Then we have some technique for bond valuation. The price of a bond is essentially the discounted value of a future cash flow, right? So valuation method include using a uniform market discount rate. Second, using a spot rate tailored to each individual cash flow. Third, time value in bond investment, which means interest rate reflect how money can grow over the time. When interest is reinvested, it can significantly amplify the return. Then we have market expression of time value. There are some metrics like a spot rate, discount bond price, compound bond price, forward rate. They capture the dynamics of the bond market. If you talk about the principle of money time value, it's very simple. 1 rupee today is more than 1 rupees in the future, because today's money can start earning immediately. So to compare amount across the time, we convert them to a single reference point, right? We convert them to a single reference point. Future value, it projects the present money forwarding using compounding. And present value, what it does, it discount future sum back to today's value. If you look at the interest and discount rate, it quantify growth potential and opportunity cost. If you look at the versatility, these concepts work for both lump sum and recurring payment like annuity. In short, we can say understanding opportunity cost and time value is key to valuing bond, planning investment, and making financial sound decision. So I think time value concept is crystal clear that 1 rupee today is worth more than 1 rupees in the future, right? How to connect this TVM to bond? I think we have discussed it. Investor prefer getting money sooner so that they can earn interest, or they can invest it till the further date. We talked about the concept of net present value. This calculates the current value of the future cash flow, helping decide if a project is worthwhile after considering the financial cost. Let's connect TVM to the bond. Very, very important. Bond pricing is all about adding up the present value of the future cash flow, discounted at the yield to maturity. That is a bond price, right? So basically, how to deal with bond pricing? You have the future cash flow, you find their present value, add all the present value, and discounting is done at the YTM, yield to maturity. There are some tools like Excel tools which we can use, right? Which we can use to make this calculation easily. You will see this term accrued interest. This is the interest earned from the last coupon date to the day before settlement, which the buyer pay the seller as a part of the total bond price. So basically, when I say accrued interest means what? Whatever interest that is earned from the last coupon date to the day before settlement. If you look at the bond price and yield dynamics, there is an inverse relation. When yield goes up, bond price fall. When yield goes down, bond price rise. If we compare YTM and coupon yield, we can say discount bond, right? If price is less than the face value, that means YTM is larger than the coupon yield. This is called discount bond. Premium bond. Price is more than the face value, right? That means coupon yield is higher than YTM. This is called premium bond. Par bond, which means price equal to the face value, which means YTM is equal to the coupon yield. So these are the three kinds of bond. We have discount bond, premium bond, par bond. In short, we can say understanding time value of money and bond price yield relationship. It helps investor make a smarter investment decision and assess the value of their bond. Now let's talk about the bond fundamental and valuation. There are some concepts like coupon rate. Coupon rate is the interest percentage of the bond face value paid to the bondholder periodically, right? Then coupon frequency, which means interest may be paid quarterly, semi-annually, annually depending on the bond. Discount, if a bond market price is less than its face value, it's called a discount. For example, a 100 rupees bond, it priced at rupees 99. So 100 rupees is the face value, 99 rupees is the market value. So it has 1 rupees discount. Macaulay duration, you can think of it like the average time it takes to get your investment back, weighed by the present value of each cash flow. Face value. Face value is the amount that issuer promised to pay at maturity. Usually it is 100 rupees in India. It is also called par, principal, redemption value. Then we have par value. So par value bond, which means what? When the market price equal to the face value, the bond trade at the par. Premium bond. If the market price is higher than the face value, it's called premium. For example, suppose 102 rupees market price on 100 rupees face value. So 2 rupees premium is there. What is the meaning of yield? Yield means the annualized return you earn based on the purchase price and the coupon. And this yield is influenced by market and economic condition. That's called yield. Yield is the annualized return that you earn. Okay. Now YTM. YTM is the total expected return if you hold the bond till maturity. It is the discount rate that make the present value of future cash flow equal to the current price. Right. The total expected return if you hold the bond till maturity is called YTM. Yield curve. It is a graph that shows yield versus maturity for the bond of same credit quality. It helps understand the term structure of interest rate and market expectation. If we talk about the bond investment return, so basically let's simplify the bond investment return. There are something called source of return. Source of return could be coupon interest. This is the periodic interest you receive from an issuer. It could be capital gain or loss. This is like a profit or loss when you sell or redeem a bond compared to the price you paid. It could be interest on interest, which means if you reinvest your coupon payment, you earn additional return through compounding. These are the three things. Then we have the coupon yield. What is coupon yield? This is the annual interest based on the bond face value. How to find the coupon yield? Very simple. Annual coupon divided by face value multiplied by 100. Right. So this coupon yield is fixed, which means it does not change with the market rate or inflation. The formula is very simple. Coupon payment divided by face value multiplied by 100. Well, let's suppose that coupon is 8.24 rupees. Face value is 100. So coupon yield will be 8.24%. That is what we call coupon yield. Then we have the current yield. So see, coupon yield is asked every year. Please understand. You write coupon in the numerator and you write face value in the denominator and multiply it by 100. That will give you the coupon yield. If we talk about the current yield, so you write coupon in the numerator, you divide it by the purchase price, multiply it by 100. That will give you the current yield. So if we compare coupon yield and current yield, we can say that current yield ignore the reinvested interest. Current yield, it ignore the reinvested interest, and it reflect the return on your invested price. That's the difference, right? That's the difference between current yield and coupon yield. Current yield, it ignore the reinvested, obviously interest get reinvested, it ignore that and reflect the return on your invested price. That's why we take the purchase price in the denominator, while in the case of coupon yield we take the face value, right? We take the face value in the denominator. So that's the difference. In short, coupon yield tells you the bond fixed promise and current yield tells you the actual return based on your purchase price. So please understand, most of the time they will ask you current yield. So what we need to take? We need to take the purchase value. At what price you purchase it. If you look at the YTM, so basically this is the ultimate measure of the bond return. It's the total expected return from a bond. It includes all the coupon payment plus the principal. You can think of its bond internal rate of return, or we call it IRR. Basically, it is a discount rate that make the present value of all the future cash flow equal to the bond current price. So it is that discount rate that make the present value of all the future cash flow. Whatever future cash flow we have, find their present value. So that present value should be made equal to the bond current price. That's called IRR, YTM, yield to maturity. How to compute it? So there are two ways, trial and error method. We adjust the discount rate repeatedly until the present value of the future cash flow matches the bond price. Work but can be complex for government security with multiple cash flow. Second method we have is the spreadsheet method, right? So Excel make it much simpler with the yield function. So there are some parameters which they take into account. So I think no need to go through that much detail, right? The next term we have is the bond duration. So basically this is the key concept for the bond investor. There are two types of things. McLeod duration, which measure the weighted average time it takes to receive all the cash flow from a bond, right? So what is the weighted average time that it takes to receive all the cash flow from a bond? Basically, it means how long it takes to get back your money in the present value term. Suppose there is a bond with semi-annual coupon. Remember to divide period by 2 to convert to year, because the answer will be in form of year. But now suppose we have a bond with semi-annual coupon, we should always divide it by 2, right? This is a very, very important thing. So how to calculate the duration? Very simple. First of all, we discount the cash flow. We use the bond YTM to bring every coupon, every principal to the present value. For semi-annual coupon, we treat each 6-month period as one period. Then we find the weight of the PV. We multiply the PV by the time period, right? You add all the weighted PV divided by the bond price, that will give you the duration in period, divided by 2, right, to get year if semi-annual. So one example they have given you, like suppose there is a bond with 2-year maturity, 10% coupon, price is 101.79, right, and YTM is 9%. So first of all you find the cash flow for the 4 half year. Obviously 2 year there are 4 half year. You find the cash flow. These are the cash flow. Then you find the PV. PV means the present value. How to find the PV? By discounting the cash flow, we get the PV, right? Then you find the weight PV, right? Very simple. Weight PV, just multiply PV with time. That will give you the weight PV, right? So then after we need to find their sum, right? And divide the sum by the summation of PV. That will give you the bond duration, which comes out to be 1.86 year. In simple word, it tells you how sensitive a bond is to the interest rate change and how long it takes to recover your investment in today's term. So that is all about bond. And modified duration, if we talk about, it measures the percentage price change for 1% yield change. So see, till now we are talking about the McLeod duration, right? So one more thing is that suppose we have higher coupon. So how it will affect the duration? If coupon is higher, so what will happen? Duration will get short, because more cash you received early. That's why the average time it takes to complete your investment, to take back your investment will be lower. right? So remember, duration and maturity, duration is always less than equal to maturity, and they are equal only for zero coupon bond. Modified duration, already I told you, it measures percentage price change for 1% yield change, right? And you know, there is a concept of basically how to find the modified duration, right, from Macleod duration. Take Macleod duration divided by 1 plus yield, that will give you the modified duration. What is the meaning of PV01? That is called present value of 1 BP. Basically it is a price change for 0.01% yield shift, right? That is called PV01. So suppose yield gets changed by 0.01%. It may increase, it may decrease. How the price will react? That is measured by PV01. It expresses the monetary sensitivity, right? Suppose we have higher PV01, it means more volatile. Then we have DV01. DV01 means dollar value of 1 PV. You know, net present value changes for 1 basis point, yield move plus 1 payment. Second thing, we have a capital gain or capital loss. This happen when you sell the bond before maturity or at maturity, right? Suppose if you sell it for more than what you paid, you get a gain, and if it is less, you sell it for less than what you paid, you face a loss. And the third thing is the reinvestment income. This is the extra return you earn when you reinvest those interest payments instead of keeping them idle. See, first of all, you have interest payment from bond. This is also called the coupon income. Second thing, there is a capital gain, capital loss. Third thing, there is a reinvestment income, which means the extra return you earn while you reinvest those interest payment instead of keeping them idle. So in simple word, you know, bond can make money for you in 3 ways: interest, profit on selling, and reinvestment. So interest payment means regular income from issuer. Capital gain and loss means profit and loss on the sale or maturity, and reinvestment income is extra return from reinvested coupon. Now friends, let's talk about the type of yield that we have. So the first kind of yield we have is called the coupon yield. So what is the meaning of this coupon yield? So basically, you know, this is the fixed percentage of the face value, right? This is the fixed percentage of the face value, and it is unaffected by the market rate or inflation. So it means what, you know, inflation or market rate does not affect the coupon yield. So let me give you one example. Suppose I say 100, suppose we have a 100 rupees bond at the rate of 8.24%. So what will be the yield? Yield will be simply 8.24%. You know, this is the most popular topic, current yield. They ask you question every year. So please understand what is current yield. So current yield is annual coupon divided by current price into 100. So it ignores the reinvested income. So suppose 100 rupees is the par value or face value, and it is sold at 103 rupees. So what is the current yield? So what is the coupon it is giving you? Suppose 8% is the coupon rate. So 100 rupees, 8% of 100 is 108. So 8 rupees coupon it is providing you. So in the numerator you write the coupon, that is 8 rupees, right? In the denominator you write the current price. So what is the current price? It is 103. So 8 divided by 103 into 100. That would be near about, you know, 8%, near about 8%. That is your current yield. And then the third kind of yield we have is called yield to maturity. In short, we call it YTM. This is the total return if held till maturity, which means if you held the bond till maturity, the total amount of return that you get is YTM. So these are the 3 yield which we used most popularly. And if we talk about the discount rate, what is the meaning of discount rate? See, we have the future cash flow, right? We find the present value of all those future cash flow, right? So that is basically what we are doing. We have a cash flow available. We find the present value of all those cash flow, right? And discount rate is equal to market price. So basically, there is an Excel tool which are used to solve these kinds of problems. I'm not going to explain all those things, right? Now, so remember, coupon yield is fixed, current yield is market based, and YTM is total return till maturity. Now friends, let's shift our focus to the day count convention. See, when it comes to bond or money market instrument, we often need to calculate how long we have held the investment. That is where, day count convention comes into picture. What does it mean? It simply means the method used to count the number of days between 2 dates. This helps in calculating the accrued interest, right? So this is the method. Right now we are talking about day count convention. It is a method which we use to count the number of days between 2 days, and using this method we calculate the accrued interest. What is the meaning of accrued interest? Basically the interest earned between 2 coupon dates. That is called accrued interest. There is a convention. This convention makes sure that everyone in the market follow the same standard so that interest calculation remain uniform. If we talk about the bond market, the standard method is 30 upon 360, which assumes that every month has a 30 day and every year has a 360 day. But in money market, we use actual upon 365, which means we take the actual number of days in a month and assume 365 days in a year. So this method is usually applied for instrument like treasury bill, right? So in short, we can say it's just about setting common ground for how we count days while calculating interest. So let's quickly revise the key point which we have covered. We started with the purpose of this day count convention. I told you it helped to calculate holding period as well as the accrued interest. If you have bond market, the notation is 3/360, which means 30 days a month and 360 days a year. And if you look at the money market, the convention is actual upon 365, which means actual day and 365 days per year. Right, the goal is to ensure uniform interest calculation across the market. That is our goal. Now let's talk about the bond duration, or we call it the McLeod duration. Very, very important thing. So whenever I say bond duration, what does it mean? It measures the time to recover the investment in PV terms. Right. See, we have an investment in the form of bond. Right. How much time does it take to recover the investment? So how to find the how to go about finding the McLeod duration? It's very simple. Remember, McLeod duration question is asked every examination. So please make sure that you have practice. And if you want to practice more, you can take our previous year question. Look at the previous year question PDF available in the course. I have explained every step by step. Right? Please solve those questions. So let's see what are the steps. First of all, we have the future cash flow available. We discount them using the bond yield. And then we get the present value, and you have to multiply each present value by its time period, right? And then find the sum of all, right? And divide by the bond price. So summation of PV into T upon summation of PV. This is the formula to find the McLeod duration, right? So and suppose the bond is semi-annual. In that case, you divide it by 2 to get year, right? So this is the point. So if you look at the key characteristics of this duration, you can see this is like a weighted average time to receive the cash flow. If the coupon is higher, so duration will be shorter. And duration is always less than equal to maturity of the bond, except zero coupon bond. Suppose that we have a zero coupon bond, and if they ask you to compute the duration, do nothing, just see the maturity. Maturity is exactly equal to the duration, right? So question may be asked, for which of the following bond duration and maturity are equal? Option A, some option they will give you. So remember, the answer is zero coupon bond. So remember, duration shows the price sensitivity, right? Higher duration means higher interest rate risk. Now, if you look at so till now we are talking about the McLeod duration. Now, modified duration, it's just a smarter, more practical version of McLeod duration, right? Modified is a smarter and practical version of the McLeod duration. It tells us how much a bond price will change if interest rate change by 1%, right? So it measures the price sensitivity to a 1% change in the yield. So how much the bond price will change if interest rate change by 1%. You can think of it like sensitivity meter for the bond. It measures how sensitive the bond price is to the interest rate change. For example, let's suppose we have a 15-year bond. It has a duration of 7. So it means that if the interest rate rises by 1%, the bond price will fall by about 7%. Right, that is what it indicates. So basically, modified duration simply measures, it very well that bond price and yield are inversely related. Whenever yield change positive, bond price change negative. So how much there is a change in the bond price whenever the yield change, right? That is what is measured by the modified duration. So basically, higher the duration, more sensitive the bond, bigger the price change with every rate movement. Remember, this is the basic equation, right? More duration, more bond sensitiveness, more the price change with every rate movement. So let's quickly revise the key point. We started with modified duration, which is a kind of improved McLeod duration. It shows the percentage price change for 1% yield change. 1% rise in yield is equal to price fall roughly by duration percentage. Higher duration means more price sensitivity. I hope this is crystal clear now. Now, there is some term like PV01, that is called present value of 1 basis point. So, what is the meaning of it? What is the meaning of 1 basis point? 1 basis point means 0.01%. Suppose there is a shift in yield by 0.01%. Shift means it can increase or it can decrease. Both things can happen. So PV01 measures that since the yield changes, so price is bound to change. How much the price is changing because of that changing yield? That is what is measured by PV01. Right? I hope it is clear. What is the meaning of DV01? DV01 means the dollar value of 1 basis point. So it shows that, suppose yield gets shifted by 1 basis point. So whenever I say shift, it means it can increase or it can decrease. That is the meaning of shift. So let's suppose that yield gets shifted by 1 basis point. So how much the NPV will change? What is NPV? Net present value will change. right? So it indicates the currency value change, and it is not limited to dollar, and it is closely, the DB01 is closely related to PB01 with slight calculation difference. Now this topic is the most hot topic for examination, that's called convexity. So what is the meaning of convexity? Bond price is non-linear, right? And adjustment for the non-linear bond price is done using the convexity. So let's understand it. Basically it reflects the change in the duration. Yes, duration also change. See, till now we were talking that when the yield change, price change. Obviously price will change, but sometimes when the yield change, duration also change. So this convexity reflect how the duration will change when there is a change in the yield. Now to suppose we have an option free bond. So what happen, whenever yield increase, price will fall, right? Price fall is less than the duration estimate, and yield will decrease, price rise is greater than the duration estimate. So remember, duration is a kind of linear estimate, while convexity is like kind of curve reality correction. Now friends, let's switch our focus to the forex and market segment. So forex, or this is the short form for foreign exchange. It simply means the trading of one currency for another, like exchanging rupees for dollar when you travel abroad. So forex means foreign exchange. It means foreign exchange. What does it mean? It means trading of one currency for another. But it is not just about travel only. It is actually the largest financial market in the world, where bank, companies, investor, they trade currency for global business and investment. Right. Unlike the stock market, forex is decentralized. What is the meaning of it? It means that there is no single exchange or location where the trading happen. Right. That is called decentralization. You cannot say that this is a single exchange or this is the location where trading happen. Instead, all the trade takes place over the counter, OTC, through a network of bank, broker, electronic system across the world. That is the meaning of decentralization. Again, I am repeating. So when I say decentralized, it means that there is no single exchange, no single location where the trading happen. It happen throughout over the counter, through the network of bank. In short, forex is a global online marketplace where currencies are constantly being bought, constantly being sold, 24 hours a day, 5 days a week. Right. So that is the peculiarity of this forex. So let's recapitulate the key points. So forex means currency trading for global transaction, world largest financial market, decentralized it is, which means OTC, over the counter, no single exchange, all are electronics, and trading happen globally through bank and network. Please remember these keywords. Next term we have is called swap. Right, swap. So let's talk about the swap market and forex trading in India. But before that, let's look at some characteristics of this forex market. So remember, this is an interbank level, and so there are three levels: interbank level, brokerage level, and retail level. So what happened at the interbank level? Major bank, liquidity provider are there. Brokerage level, broker execute trade for the client. And retail level, what happened? Individual trade via aggregator. So that this forex market happened at the three level. Now obviously it is the global connectivity, 24/7, not 5. 24/7 operation is there. It link dealer and market maker, right? So what a spot market? So this is a kind of segment. So whenever I say this word spot market, what does it mean? That immediate currency exchange at the current rate, whatever rate is prevailing right now, and currency exchange is happening at that particular rate. That is called the spot market. So the key feature of a spot market is that instant settlement, minimum volatility risk. Volatility does not impact these kinds of market. Second kind of market we have is the future market. See, whenever I say this future market, what happened? This is a kind of contract, and a standardized contract for future exchange at the fixed rate. It offers stability, it offers predictability to large trader. Third kind of market we have is forward market. Like it is just like a future, but customizable terms, higher flexibility. Fourth, we have the option market. So whenever you see this word option, please remember this is a right, not obligation, to exchange at the fixed rate before a set date. It enables a strategic speculation or hedging. So just remember these keywords. A spot means now, future means fixed future, forward means flexible future, option means choice without obligation. Right? You have a right, but you don't, no obligation is there. Now let's look at the swaps. Swap is basically a financial agreement between two parties. So two parties are there. They are undergoing financial agreement where they exchange cash flow, or where they exchange sometimes the value of asset. That is called the swap. So friends, swap is a kind of financial agreement between two parties where they exchange cash flow, or sometimes they exchange the asset value. Right? You can think of it like this. One party agree to pay a fixed rate while the other party pays a variable rate, which is often linked to the interest rate or foreign exchange rate. So this is how the swap happen. So these deals are not traded, right? Remember, these deals are not traded. These deals are not exchanges like a stock or future. Instead, they are customized, right? They are customized and privately arranged between the two party. That is what we call, OTC trading. So question may be asked whether the swap deals are traded on exchange like a stock and future. No. They are customized one. They are privately arranged between the parties. Okay, one party agree to pay a fixed rate, other party pays a variable rate, right? And the biggest advantage of the swap is that, is flexibility, right? Which means both sides can design the contract as per their need. In short, we can say, swap help institution manage risk or adjust cash flow according to the changing market condition. So friends, some points related to swap I just talked now, that it is kind of derivative contract for exchanging cash flow or the asset value. One leg is fixed, other leg is variable. OTC deal it is, which means not traded on exchange, and quite flexible, quite customizable to suit both the parties. Now friends, nature of swap just now I told you, right? So basically, this is a privately negotiated deal, right? It's not a standardized futures and options contract. It is tailored contract to suit participants' needs. And multiple styles are there to match the trader goals and temperament, like scalping. So this is an ultra short term trade, small profit, high frequency, day trading. So what happened in the day trading, all the trade within one day, happen within one day. Then we have the swing trading. Swing trading, it is a medium term like day or week, right? It captures the market swing. Then we have the position trading. Position trading, what happened, it is a long term, week, month based on fundamental trend. So if we talk about scalping, what happened, that basically we are trading rapid trades, and it's aim at tiny price move. And this scalping rely on leverage and large position. It needs sharp analysis. It does not need any patience. And style selection, the success depends on matching trading style with temperament. Now if you look at the day trading, this is the second type of swap arrangement that we have. So day trading means you are buying and you are selling within the same day. You enter and exit a trade before the market closes. The goal of day trading is to make quick profit from a small price change that happened during the day. The day trader often use high leverage. Yes, this is the key advantage. They use high leverage. What is the meaning of high leverage? It means they borrow fund to take larger position. And this can increase profit, but it also increase the risk if the market move the other way. You will mostly see day trading in Forex and the stock market where price move to frequency. So what we have talked just now, I told you that swap, swap is a kind of customizable derivative. Scalping deals with speed, day means daily action, swing means short trend, and position means patience. Please remember these words, very, very important. So day trading, I told you, now you are buying and you are selling within the same day. The goal is to make quick profit. Day trader use the leverage, right? And you will mostly see day trading in Forex and stock market. A typical day trader, is someone who is well informed, financially strong, and he or she is ready to act instantly on breaking news like interest rate change, inflation data, or global event. That is called day trader. In short, day trading is all about speed, timing, and discipline. It's not about holding position overnight, but also about capturing the intraday move. So just now, let's quickly revise the key points. Buy and sell same day, right? Use high leverage, common in Forex and stock market, and day trader are educated, quick, and trade liquid asset. Remember these key points. Now, then we have the swing trading. So if we talk about the swing trading, they target short to mid-term gain. They are based on the technical analysis of the market swing, right? And as compared to scalping, monitoring requires less. The fourth kind of, swapping technique we have is called, position trading, which is the kind of long-term strategy, right? Position trading is a kind of long-term strategy. Please note it down. And they focus on the sustained growth. And one who is a fundamental investor, he want to learn everything. So for them, this position trading is the best method. Now, if we talk about the Forex quotation, so you can see, that when I say quotation, what does it mean? It shows the exchange rate between two currency. Suppose we have a currency pair and we want to know the exchange rate. So that can be known through the Forex quotation. Like suppose I say euro per dollar is 1.1404. So that means 1 euro is equal to $1.1404. If you look at the ISO currency code, it is a kind of 3-letter standard code set by ISO, right, International Standard Organization for global use. like EUR for euro, USD for US dollar. So remember, day means daily action, swing means short trend, position means long vision, and quotation means currency pair logic. Now let's switch our focus to the essential of exchange rate and forex transaction. Very important topic. So exchange rate simply tells us how much one currency is worth compared to the another. For example, suppose I say $1 is equal to 84 rupees. It means you need 84 Indian rupees to buy one US dollar. You know, this rate keep changing daily depending on global demand and global supply, right, of the currencies, trade flow and interest rate. And you know, this exchange rate is the core foundation of all the forex transaction. It is a core foundation of all the forex transaction, because you know, every foreign exchange deal, whether it is for import, export, travel, investment, they depends on this exchange rate. So in short, we can say the exchange rate is just the price tag of a currency when compared to another. It's just the price tag of one currency. So whenever you see this word exchange rate, it means what? You know, price of one currency in terms of other. For example, $1 is equal to 84 rupees. And you know, this changes daily. That depends on the demand, supply and market focus, and is the foundation for all the forex transaction. Now friends, let's look at what is the rule regarding the forex transaction, right? Let's look at some rules. So basically, you know, there is something called, you know, variability in rate, right? Variability in rate. And then we have the you know, sell transaction rate. So here you can see there are two ways to quote. The first way is called direct method. Second way is called indirect method. So direct method means, you know, you have a fixed foreign currency, variable local currency. Like suppose I say $1 is equal to 61.50 INR, right? So here what we can see that our foreign currency is fixed, like dollar is fixed, and our local currency, which is Indian rupees, is variable, right? So, and you know, this is used in India since August 1993. And if you talk about Japanese yen, they are quoted per 100 unit due to the low value. Then we have the indirect method, indirect currency, indirect quotation. What happened here? You know, we have local currency fixed, our local currency is fixed, and foreign currency is variable. For example, let's suppose I say 100 INR is equal to $1.6260. So these are the two kinds of quotation that we have. If you look at the types of forex transaction, so they are classified as purchase or sale by bank, based on whether the bank acquire or whether the bank releases the foreign currency, depending on what is happening. So either, you know, bank is acquiring or bank is releasing. So they are either purchase or sale, purchase transaction or sale transaction. If we talk about the purchase transaction, as the name suggests, the bank receives the foreign currency. From where? So bank may receive foreign currency from exporter, right? They may receive from exporter, or they may receive foreign currency using FCN, foreign currency note, TC, DD, inward remittance, right? Then we have the sale transaction. Sale transaction means bank provide the foreign currency to whom? Obviously bank will provide the foreign currency to the importer, right? So these are the two kinds of sale and purchase transaction that we have. One more point is that direct means one FC in the LC value. Indirect means one LC, one local currency in the FC or foreign currency value. Purchase means bank get foreign currency. Sale means bank give foreign currency to the importer, right? Now there is something called variability in rate, very important. So you know, in forex market, not all transactions have the same exchange rate. The rate actually changes depending on the types of transaction. Why? Because each kind of transaction has a different level of processing, different level of documentation and handling cost, right? So because of this reason, you know, there is a variability in the rate. So that is why I told you that in forex market, not all transactions have the same exchange rate. Different forex transaction, different rate. The rate actually changes depending on the types of transaction. So I told you now, for example, suppose you are sending money abroad through a telegraphic transfer, let's say TT, right? So if you are sending money abroad through a TT, it's quite quick, it's quite simple. But handling an import or export bill involves checking documents, following up, collecting payment. So the rate offered by the bank will obviously differ. So in short, we can say that, you know, that the more complex the process is, the less favorable the rate for the customer. So what we just learned, let me just summarize. I told you that different forex transaction, different rates will be there. And it depends on the processing complexity and handling effort. Simpler process, better rate. Complex process, lower rate. I hope it is crystal clear now. Now, what is the influence of the interest rate? Let's talk about it. So influence of the interest rate on the forex firm, I will talk about it. Before that, let's look at some purchase transaction rate. We have something called bill buying rate. So bill buying rate is to be used for, you know, export bill. And you know it very well that lower the rate, this rate is lower because of the extra processing. And then we have the TT buying rate. This is for, you know, inward remittance, right? Inward remittance we use the TT buying rate. And it is better rate, simpler process, right? And if you look at the other instrument rate, so there is a separate rate for the foreign currency note and traveler check. Now what is the influence of delivery timing? Rate code depends on the delivery timing a lot. Very important thing. Rate quotation depends on the delivery timing, which means settlement date, and it reflects the timing of the deal finalization. So you can see the TOM. First type is TOM. Right, okay, ready or cash. Whether we call it ready or cash, both means the same thing. So what is the meaning of ready or cash? It means same day and immediate settlement happen. TOM is tomorrow. Tomorrow means next working day, and the gap is for 1 day. Then we have the spot. Spot means 2 working day, and this is kind of a standard forex deal. Forward happen after the spot at premium or discount based on the currency demand and supply. So remember, telegraphic transfer is the fastest. Bill is a process heavy. Forward means future deal with premium and discount. Now if we talk about the influence of interest rate on forex forward rate, let's understand this. Very important. Interest rate link. The forward exchange rate between two currencies is not random. It is mainly driven by difference in interest rate of the two countries involved. Right, very important thing, that the forward exchange rate between two currencies is not random, rather it is driven by the difference in interest rate. You can think of it like this. If you are holding one currency, there is a cost, there is a benefit depending on that country interest rate, right? So what I'm telling you, that suppose you are holding one currency, there is obviously a cost of fund, right, or benefit depending on that country interest rate. So the forward rate adjusts itself to reflect this cost of carrying or holding a particular currency over the time. Yes, that forward rate adjusts itself. There is a cost. If you are holding one currency, there is a cost or benefit depending on that country interest rate. In simple word, we can say the forward rate bridges the gap between the current rate and the difference in the interest rate between the two currencies. This is what the forward rate does. So remember, forward rate depends on the interest rate differential. Very important thing. And it reflects the cost of holding fund in each currency. Forward rate ensure that fair pricing for future exchange rate. Right. So you can see the trend here. Suppose there is a higher interest rate currency. So that will be in discount in the forward contract. If it is lower interest rate currency, it will be premium in the forward contract. How do we compute the forward rate? It is very simple. If we have the direct quotation, we just take the spot rate. If it is premium, just add it. If it is discount, just subtract it. And that is how you will get the forward rate. And if it is indirect quotation, then you have to do the opposite. So remember, forward rate adjusts for interest rate gap. Higher rate currency, cheaper forward. Low rate currency, costlier forward. Please remember this point. Now currency identification. So there is a 3-letter ISO codes. Please understand it. Every currency in the world has unique 3-letter ISO code, like USD for US dollar, INR for Indian rupees. So there is no confusion in international trading. And currencies are also classified based on how widely they are traded. There are some major currency which are most popular and highly liquid globally. There are some minor currency which are traded often but less than the majors. Exotic currency, there are very rare, or emerging market currency, often riskier and less liquid. So in short, we can say ISO code make it easy to identify currency, and classification tells us how widely they are used in the forex market. So remember, ISO code is a unique 3-digit currency identifier. Major, higher trading volume and liquidity. Minor, moderate trading. Exotic, emergency or less traded higher currency. Let's talk about some prominent name they have given you, right? Now let's talk about the currency pair, right? So currency pair, major pair I told you, minor pair, exotic I told you, exchange rate quotation, I think we have discussed all these things, right? Now exchange rate fundamentals, very important. Let's clear the fundamentals first. So bank quote exchange rate based on whether they are buying or whether they are selling the foreign currency. When I say purchase rate, it means when the bank buy foreign currency from you, it uses a rate aligned with the market buying rate. And when the bank sell foreign currency to you, it uses a rate aligned with the market selling or acquisition rate. So there are two kinds of rate, purchase rate and selling rate. Purchase rate means when a bank buy foreign currency from you, right? So in that case, that rate is aligned with the market buying rate. That's called purchase rate. And second case, when the bank sell foreign currency to a client or to you, right? So there's a rate. It uses a rate that is aligned with the market selling rate. In simple word, bank always adjusts its rate depending on whether it is giving you money or it is taking from you. So quick way to remember it, you must remember it. Purchase rate means bank buy foreign currency. Sell rate, bank sell foreign currency. Principle is, rate differ based on bank buy or bank sell action. That is what decides, right? Now you can see market merchant rate is just like interbank spot rate plus or minus exchange margin, right? And margin varies by the transaction type. So there are some currencies they have mentioned here, like dollar, maximum spread from mean rate is 1%. For GBP, Euro, Australian dollar, CHF and JPY, maximum spread from mean rate is 2%. Other currency minimum feasible. Now let's talk about the merchant rate formulation. So it's basic simple, buy low, sell high. So if you have purchase transaction, then you take the base rate, you subtract the margin. Remember, the margin is always to be subtracted in the case of purchase transaction. And if it is a sell transaction, we take the base rate and we add the margin. So it ensures that competitive pricing for the client. So remember it. Now let's talk about the TT buying rate. TT buying rate is the rate at which that the bank use when it receive foreign currency from abroad. It is like inward remittance or deposit. Suppose a bank is receiving foreign currency from abroad, like inward remittance. So in the case of inward remittance, we use the TT buying rate, right? Suppose it is commonly applied to some cases. Let me tell you some cases, like export proceed, right? Bill collection is there, or suppose refund is there, cancellation is there. So in these cases, TT buying rate will apply. It also convert foreign deposit or loan into the Indian rupees. Now the question is how to compute this TT buying rate. Very simple. First of all, we take the base rate, which is the market purchase price of the currency. We adjust for any exchange margin. What is exchange margin? It is a very tiny percentage deducted by the bank, and we round the final rate to the nearest paisa for the client. In short, we can say TT buying rate is the bank rate for crediting foreign currency to your account. So this is the simpler way to understand. Suppose bank is crediting foreign currency to your account. The rate that we use, right, after applying minor adjustment, right, that is called the TT buying rate. That's called inward remittance, right? So remember, TT buying rate is the rate for inward remittance, and step is, first of all, you take the base rate, you deduct the margin, and you round off. And it is applied to export proceed, like bill, RFC, EFC, FCNR deposit. In these kinds of things, you apply the TT buying rate. It is just the bank rate for crediting the foreign currency to your account. That's it. Second rate we have, is called bill buying rate, or we call it OD buying, right? So what it is, suppose you are purchasing a bill, you are discounting a bill. When I say purchasing and discounting, I think you are familiar with it. What bank do, bank pay rupee now, and it will receive foreign currency later. That is called the discounting of bill. So Ujans bill, you apply the forward rate, and side bill, no forward rate is there. We apply the spot rate, right? That is the point. So remember, TT buying is the rate for inward remittance and deposit conversion. Bill buying is the rate for export bill and delayed forex receipt. Now let's talk about the refined methodology, right? So bill buying rate in terms of dollar. Now friends, the bill buying rate, that's called BBR. It is a rate that the bank use when it buy export bill or when it buy the draft in the foreign currency, especially for the future delivery. So since the payment is not immediate, right? Very important thing to note is that if we talk about the bill buying rate, payment is not immediate. It's a usance basis, right? So what we do, we apply a forward premium, a forward discount is applied to the current spot rate. So let me give you an example. Suppose the base rate is 61.50. So I say that $1 is equal to 61.50 rupees. Then we add a forward premium. Suppose our forward premium is 0.60. Right, so subtotal it become how much? 62.10, and then we deduct the margin. Margin is suppose 0.15 or 15%. So final BBR is 62.01. That is called the bill buying rate. So in short, we can say that BBR, that is bill buying rate, it adjusts the spot rate for future delivery. So remember, bill buying rate is used for export bill and deferred payment, and TT buying rate is used for inward remittance. Okay, just now I have told you. Now the question is, in the TT buying rate there was no premium. Why in the bill buying rate there is a premium? Because bill buying rate deals with those cases where the bank pay the money now and bank will receive payment at the due date, right, of the bill. That's why premium comes into picture. Now friends, let's talk about the TT buying rate in terms of traveler check and dollar. Okay, so whenever we purchase the foreign currency traveler check, how do we deal with it? First of all, you take the base rate, deduct the margin, right, and subtotal round it to the nearest paisa. That's it. Now we have currency note buying rate, CN. This is the purpose is simple, to purchase. Friends, TT selling rate is the rate that a bank charges when it sends the foreign currency abroad. TT buying rate, inward remittance. TT selling rate, outward remittance, right? So how to compute it? Very simple. Take the base rate, add the exchange margin, and you get the final TT exchange rate, right? So in simple term, TT selling rate is the price that you pay to buy the foreign currency from the bank. It includes small charges for handling and processing. So friends, please remember these points. TT selling rate for outward remittance. First of all, we take the base bank rate, then we add the bank margin and you get the final client rate. Remember, margin is always to be added in the case of sell transaction and margin is always to be subtracted in the case of buying transaction. Please remember it, right? So this is the point, TT buying rate, TT selling rate. Now let's talk about the financial derivative. Financial derivative, and before that it is TC selling rate, traveler check selling rate. Again it is very simple. You are selling the foreign traveler check to the client. Very simple, take the base rate, add margin, and that's it. Then we have the currency note selling rate, we call it CN selling rate. So that is all about, you are selling the foreign currency notes to the customer. Take the base rate, add margin, you get the foreign currency selling rate. So these are the steps that you have to follow: TT, bill, TC, currency notes, etc, etc. Right. Now let's talk about the cross rate. So what is the meaning of cross rate? We use USD dollar as an international intervention currency. Remember, this is called intervention currency. So the dollar is used to derive INR rate for non-USD currency. So it's very simple. Let's suppose I say that $1 is equal to 61.50 rupees and $1 is equal to 1.1377 CAD. Now you can link this Canadian dollar with the rupees using the dollar. Dollar is acting like an intervention currency, right? So you can simply say that 1 CAD is equal to 61.50 divided by 1.1377, which is equal to 54.07 rupees. So this is how cross rate works. Now let me give you some example of the matching transaction. You know it very well that this transaction is used to align export proceed with import obligation to minimize the interbank exposure, right? So this is applied as no spot dealing risk exists, right? So qualification criteria is that transaction amount should be nearly equivalent, that means plus minus 10%. Like suppose I say inward $50,000, which is near about outward $45,000. So remember, in the case of cross rate, dollar acts like a bridge. Match transaction offset trade risk plus lower margin. Now let's switch our focus to the derivative. So derivative, it is a financial contract whose value come from something else, like a stock, commodities, currencies, or market indices. That is derivative. So derivative are essentially an agreement between two or more parties where the payoff depends on how the underlying asset price move, right? So we are talking about derivative. So for kinds of financial contract, value come from something else, a stock, commodities, currencies. The best part is that they are quite versatile. You can use derivative to protect your investment. That's called hedging. You bet on price movement, you can use derivative to bet on price movement. That's called a speculation. Or you can leverage your money for higher potential return. So in short, we can say that derivative are financial tool that link value to the underlying asset. So first point is that asset linked value is there. So that means depends on the stock, commodities, currencies, or indices. Contractual between the parties, right? Some uses I told you: hedging, speculation, and leverage. Now just now I told you the functions of derivative. Functions of derivative, first is the hedging. Hedging means protecting the portfolio from adverse price movement. Then we have the speculation. A speculation means profit from anticipated price change. If you look at the user of the derivative, so the first user is the hedger, right? Hedger is a user of derivative. Hedger means what? He safeguard investment, reduces volatility. Speculators also use derivative to seek profit from the price swing. Arbitrager, he exploit market price difference for risk-free gain. Leverage seeker, he amplify return with a small capital. If you look at the types of derivative we have, the first kind of derivative is option. You know what is option? Option means you have the right but not the obligation to buy or sell at a predetermined price. Then we have the future. Future means a standardized contract to buy or sell at a fixed price. Right, this is a kind of exchange traded contract, options, future. So remember, derivative it includes risk tool plus profit opportunity. Key users are hedger, speculators, arbitrators, leverage seekers. Now let's look at some derivative instruments that we have. The first instrument is called future. You know what is future? Future are the standardized contract traded on exchange, right? It obligate you to buy or sell an asset at a fixed price on a fixed date. Right, so it's kind of exchange traded contract, a standardized one. You can buy or you can sell at a fixed price at a fixed date. Very liquid and it is easy to sell, easy to trade. Then we have the forward contract. Forward contract is customizable over the counter deal. Future is a standardized, while forward contract is OTC deal. They have flexible term, and in terms of liquidity, as compared to future, they are less liquid. Third kind of derivative purpose, we have FRA, forward rate agreement. So this is the kind of forward contract on interest rate for a notional amount. So this is a kind of forward contract on interest rate for a notional amount, and it helps in hedging the interest rate risk. Then we have the forward, we have the swap. So forward is also an OTC. See, We have seen that forward is an OTC contract. We have also seen that forward contract is an OTC contract. If you look at the swap is an agreement to exchange cash flow, to exchange instrument, right? So let me just summarize. Future, standardized, exchange traded, high liquidity. Forward, flexible, private OTC contract. FRA, which means forward on interest rate. Swap, exchange rate, cash flow or asset for the risk management. Now let's look at the strategic use in the risk mitigation, right? So counterbalance adverse movement in the asset, interest rate, forex exchange, commodity, right? These are the points. So derivative includes two things: hedging and speculation. Swap and FRA are for interest rate management, and forward offer you flexible OTC contract. Now let's look at the derivative for commodity risk and speculation. Let's talk about it. So we can mitigate the commodity price risk. So futures as an option, they lock price in advance and they protect producer from adverse price movement, right? So then we have the protective puts. What it is all about: you buy put option on appreciated stock and you have the right to sell at predetermined price. Then you have the speculating on asset price movement. So you take position to profit from expected price change. And there is a high risk and reward which offer you potential for substantial profit or losses. Leveraging derivative, right? If you talk about the leveraging derivative, it means larger exposure with less capital, which amplify the return as well as the risk. So this is all about the derivative. Remember, derivative, already I told you what is the meaning of derivative. Now one more point is forward contract. Let's talk about the forward contract. So forward contract is a custom agreement. It's kind of OTC derivative to buy or to sell an asset at a specific price on a future date, right? So this is a kind of custom agreement. Custom is customizable, right? People use the forward contract either to hedge. Hedging means what? Protecting, right? Protecting themselves from price swing, or to speculate. Speculate means betting on future price. So in simple term, we can say that forward contract let you lock a price today for a transaction in the future. So remember, forward contract is an agreement to buy or sell at a fixed future price. Purpose is hedging, or hedging means reducing the risk. Speculation means profit from the price move. So remember these two words, customizability and flexibility, right? These two are a very, very important thing. Now this is tailored for specific commodities. Over the counter nature, which means it operates outside the centralized exchange, right? That is meaning the OTC nature. And it offers highly customization, but higher counterparty risk is obviously there. What is the meaning of counterparty risk? See, so counterparty risk arises when suppose one party default, right? He does not comply with the obligation. In that case, obviously a risk is there, and that risk is called counterparty risk. Okay, so it includes agriculture, energy, precious metals, all things are included under the forward contract. Please note it down. And now let's look at one example of the contract executions. That's what we're talking about. So imagine a farmer selling 20,000 bags of paddy at rupees 4,500 rupees per bag 6 months from now through a forward contract. They choose cash settlement, right? Meaning instead of delivering the paddy physically, the price difference is settled in cash to manage the price risk. Okay. Now in simple terms, the contract locked the selling price today, giving the farmer protection against the future price change. Right. So what I told you, that forward contract example I have given just you, that like suppose you are selling 20,000 bag at 4,500 rupees in 6 months, price difference paid in cash instead of physical delivery. The purpose is very simple, to protect against the future price fluctuation. Then we have the future, we have something called future trading. Yes, let's look at this future trading. What is the meaning of future trading? It is an agreement to buy or to sell an asset at a set price on a future date. See, in the case of forward contract, it was just a customizable deal, not an agreement. Whether this is a kind of agreement, right? People use future to lock in price, protecting themselves from the market fluctuation, or they can also use to speculate on price movement for potential profit. In simple word, we can say, that future let you pay plan ahead by securing a price today for something you will buy or sell later. That is the future contract. That's the gist of future contract, right? Some trading platform I have just given you the name of, right? Now let's talk about the future contracts, some more important points. So future contract cover many type of asset, like it may cover energy future, like crude oil, gas, gasoline, heating oil. It includes equity futures, like single stock or single baskets. It includes interest rate future like hedge or bet on change in the bond or treasury rate. It includes precious metal future like gold, like silver, which safeguard against economic uncertainty. It includes stock indices future, which is linked to indices like S&P 500. Right? So there are different kinds of future we have. Some peculiarity of future trading they have mentioned that future contracts are always standardized, means quantity, quality, delivery terms are fixed, and this makes trading smooth and trading efficient on exchanges because everyone know exactly what they are buying and what they are selling. And the benefit are transparency, high liquidity and accurate pricing, no confusion, no dispute about the contract term. Right, remember these key points. One more point is that so what we have talked just now, standardization, which means fixed quantity, fixed quality and delivery. Benefit I told you already. Now future trading overview, let's talk about it. So friends, let's talk about the overview of the future trading. Here you can see the first point they have mentioned is the strategic price protection. Future contract help business and investor protect against the unpredictable price change. For example, suppose there is a company which is buying oil, they can lock in a price today for delivery later, ensuring budget stability as well as safeguarding the profit even if the market price changes. So purpose is quite simple, to stabilize budget, to protect profit and to lock future price today. That is the main point. Okay, and this future act like an invest, but there are some drawback also, like sometimes loss get amplified beyond initial margin. Opportunity loss is always there, so some favorable gain they may miss it. So these are some kinds of disadvantage that we have. Then future as investment vehicle. So basically that futures have two main purpose for investor. First thing is speculation, second thing is hedging. Speculation means you can try to profit from price change without actually owning the asset. You have not owned the asset, yet you are trying to profit from the price change of the commodity. That's called a speculation. Second thing is hedging. That's called dual purpose utility. Hedging means what? Hedging means you can protect your investment from loss if the price move unfavorably. Yes, suppose the price move unfavorably, in that case you can protect your investment from loss. This give investor flexibility to manage risk or chase profit strategically. Right, some inherent risk is always there. You can see hedging misstep, so wrong opposing position can amplify the loss. Daily price volatility is there, right? So speculation, which means gain from price movement. Hedging means protect against market decline. So remember, futures are the flexible tool for the strategy as well as the protection. Now let's talk about the options. Let's talk about the option, what it is all about. So option are financial contract whose value depends on another asset. So option value depends on asset like stock, indices or ETF. They give investor flexible way to invest or manage the risk. So some points they have mentioned like derivative. Derivative value come from the underlying asset. Then flexibility, a strategic investment tool it's like. There is something called contractual flexibility. So the buyer of an option has a right but not the obligation to buy or sell the underlying asset. Unlike future, you don't have to execute the trade if it is not profitable. So remember, buyer right but not obligation. Future is mandatory execution. We have the word that's called expiration and pricing. So option have a fixed expiry date. You must decide to act before this date. And the strike price is the aggregate price at which you can buy or you can sell the asset. So remember, expiry date is like a deadline to act, and a strike price is a preset transaction price. There are some terms like market accessibility, which means options are easily traded online via digital platform, via broker, making them accessible to most investors. So they are accessible via brokerage and online platform. Strategic versatility. So option allow hedging, speculation, earning income. Two main types are there. Call option, which means right to buy. Put option, right to sell. So call means buy, put means sell. Purpose is very simple. Risk management and profit strategy. If you look at the contract dynamic, please understand that buyer pays a premium to get the right, and seller, who is also called the writer, he takes on the obligation to fulfill if the buyer exercises. So buyer means buyer is right, seller obligation. If you look at the call option mechanics, so call option let you buy the asset at a strike price within the expiry date. Yes, there is an expiry date for every option. Within the expiry date, you can buy the asset. And the call option is based when you expect price to rise. That's called bullish market. When you expect the price is going to rise, then you can exercise the call option, right? Bullish market. So call means buy right, and bullish market expectation you can use this call right. Then let's talk about the put option. So put option means what? That it gives you the right to sell an asset at a pre-agreed price, right? That's called a strike price, but not the obligation. It is useful when you expect the market to fall. That's called bearish market, right? And want to profit or protect your holding. So put means right to sell and use it the bearish market outlook. Market sentiments option reflect market mood. Call option is buyer expect price rise, optimistic market, and seller expect price fall, pessimistic market, right? And put option is buyer expect price fall, pessimistic market, seller expect price rise, optimistic market. So remember, call is optimistic for buyer, pessimistic for seller. Put means pessimistic buyer, optimistic seller. Strategic motivation, investor can use option for leverage, hedging, income generation, commodity access. These are the keywords, right? There is some terms, two important numbers that help the trader. That's called daily trading volume, which means how many contracts are traded that particular day. Open interest. Open interest means what? A total active contract, right? So some types of option they have mentioned, like American option, which means A for America, and you can A for any time. You can exercise your option anytime before expiry. This way you can remember A for America, A for any time. You can exercise your option anytime before expiry. Second type we have European option, which means you can exercise only at the expiry date. E for European, E for expiry. This way you can remember it. A for American, A for any time. E for European, E for expiry. Right. Exercise means you can use your option to buy or sell an underlying asset. So American means anytime, European means at expiry, and exercise means you are activating your right. Now, call option give the right to buy at a strike price. If you have a long call, it means buy if you expect price to rise. Profit, unlimited profit if the price rises, and loss you have to pay the premium, right? Obviously. So quick revision, let's just talk about the points. Call means buy right, long call means bullish market, and maximum loss you can have is the premium. Put option similarly gives you the right to sell an asset at the strike price, right? And a long put means profit if the price if the price fall. That's called bearish market. That's called long put. And protective put means act like a floor to protect the portfolio value. So put means selling right, long put means bearish play, protective put means safeguard holding, right? Remember these keywords. Now let's talk about some more important points, characteristics of options. Now friends, options comes in two style, American option and European option. An American option means A for America, A for any time. You can exercise option any time before expiry. And European option means what? You can exercise only on the expiry date, right? So American means any time, European means expiry only. Then we have the market prevalence. What does it mean? So most US stock indices, they use European style option, and individual stock usually follow the American style option. Remember, indices can be European and in single stock means American. Then we have the premium implication. American option are costlier than European one because of the early exercise flexibility. And if we talk about the vanilla option, they are very simple, a standard option to buy or sell at the strike price. So friends, if we compare American option and vanilla option, so vanilla option are very simple, a standard option to buy or sell at a strike price, and American option are costlier than European one due to early exercise flexibility, right? So question may be asked, if you look at the contract structure, so a standard option usually cover 100 share per contract, like premium is 0.35 rupees per share, total will be how much? 35 rupees per contract, and premium depends on strike price and time to expiration. So remember, contract means 100 share, premium has two components, strike and time. Then let's talk about the expiration dynamics. So option expire like perishable goods, daily, weekly, monthly, quarterly, and most monthly option expire on the third Friday of the month, right? So expiry means timing matter, and monthly option means third Friday. Remember these key points. Okay, so these are the points. Now let's talk about the strategy and risk analysis in terms of option. So friends, that trader often use option spread. Right, trader use something called option spread. Option spread means you are buying or you are selling the option together. That is called option spread. Which means why to do that? So to customize the risk and reward, they use option spread. Who? Trader. And this strategy work in upward, downward, neutral, volatile market, all kinds of market. This option spread option work very well. The potential gain, the potential loss are often shown in the profit and loss diagram, like buy call spread, or something called iron. They use the word iron condors, right? So option spread means tailor risk reward, and the diagram is a visual payoff. Now let's talk about the risk assessment. So Greek help trader measure risk in option or portfolio. The Greek quantify how the option react to the change in the underlying asset or other factor, right? So there is something called delta. Delta shows how much an option price change for 1 rupees change in the underlying asset. Suppose there is a 1 rupees change in the underlying asset, how the option price will change, that is measured by delta. If we have call option, that means delta 0 to 1. It moves in the same direction as the stock. If we have put option, which means delta 0 to -1, it moves opposite to the stock, right? For example, call delta 0.50, it means stock increased by rupee 1, so option increased by 50 paisa. So call means positive delta, put means negative delta. Delta indicates the price sensitivity. If you look at the hedging utility, so delta help in hedging the position. For example, I say call delta 0.40. It means you sell 40 share of the underlying to neutralize the risk. Right. So remember, this is called delta. So option Greek plus Greek like delta, they help trader strategically manage risk. Right. These are the points. So just now I told you about delta. So delta can also be seen as the profitability of an option ending in the money. It can also be seen as a profitability of an option ending in the money. You know, in the money, at the money, out of money. For example, suppose I say call delta 0.40. So it means there is a negative 40% chance that this option will be profitable at expiry. Right, please remember it. There is something called theta. Theta is called time decay. Theta measures how much value an option loses each day as it gets closer to the expiry. Right, it measures how much value the option loses each day as it goes closer to the expiry. For example, I say theta 0.50. It means option loses 50, there is a currency name, per day, right? So it means 3 days it will lose 1.50 rupees. So behavior, you know, at the money, if it is at the money, it means, you know, time decay is very faster. And if it is out of the money, it is a slower decay. You can think of it like this. And gamma, you know, gamma is called delta sensitivity, which means it shows how delta change when the underlying move rupee 1. For example, suppose I say call delta 0.50 and gamma I say 0.10. It means stock increases by rupee 1, delta increase by 0.10. So trend, you know, it's very simple trend that it peaks for at the money option, lower for in and out of the money option, increases as the expiry nears. It amplifies the 14 days. It can be term money from 15 days up to 1 year. So these are the different segments of this money market. The main player of the money market are bank and NBFC, right? While RBI and SEBI, they keep an eye on how everything operates smoothly. Overall, the money market plays a crucial role in ensuring short-term liquidity. Yes, short-term liquidity to ensure and maintaining a steady flow of fund. So what we learned from this particular slide, let me just summarize the points. I told you that it deals with the short-term fund, which means less than 1 year, highly liquid, low risk is there, used for managing temporary cash need, regulated by RBI and SEBI, and they keep financial system stable and liquid. These are the key points, please keep in the mind. Now friends, let's break down the role and structure of the money market in simple word. So the main role of the money market is to make sure that there is enough short-term liquidity. Yes, this is the role, to ensure enough short-term liquidity, which means cash is easily available when required. When I say short-term liquidity, it means what? You know, cash is easily available when it is required, right? And to enable a smooth transfer of money. Here you can see the word they have written, a smooth fund transfer, or we can say a smooth transfer of fund across different part of the financial system, including the, government security market. So the main role of money market is to make sure that there is enough short-term liquidity, and short-term liquidity means cash is available when required. And second thing is, and to enable a smooth transfer of fund, right? To enable a smooth fund transfer across different part of the financial system, which includes the government security market also. Now the segment of money market depends on how long the money is lent or how long the money is borrowed. It can be overnight market for just 1 day. It can be notice market for 2 to 14 days. It can be term market for 15 days up to 1 year. The participants in the market are mainly bank and NBFC, non-banking financial company, who use this market to manage liquidity or get quick short-term funding. This market is closely regulated by the RBI, is closely regulated by the SEBI, ensuring stability and transparency. For investor, the money market offer a low risk and a stable return investment option, which is ideal for those looking for short-term safety rather than long-term growth. Now, if we talk about in terms of risk management, there are two smart strategy. The first is called HTM, or we call hold to maturity. Simply, you hold your investment till it mature. This avoid market price fluctuation. Second risk mitigation technique we have, strategy we have is called portfolio rebalancing. When I say portfolio rebalancing, it means you adjust between the short term and long term instrument to optimize the return. But remember, it involves transaction cost. So whenever I say portfolio rebalancing, it means you are adjusting between the short term and long term instrument, right? The adjustment. But the drawback is that this involves the transaction cost. Now finally let's look at some key instrument like call money is there. Call money, they are unsecured overnight loan used only by bank and primary dealer, that is called call money. Repo, that is repurchase agreement we call it. It is a secured short term borrowing method where securities are sold and later repurchased at a fixed repo rate. So it is a kind of collateralized loan. So let's summarize what we learned from this particular slide. So I told you that the key takeaway is that money market maintains short term liquidity, it maintains the fund flow. There are some segments of it: overnight market, notice market, term market, right, term money market. These are the different segments of it. Participants include bank and NBFC. Regulators are RBI and SEBI. It is safe, low risk, short term investment, right. Key tools are call monies and repo. These are the key instruments which are used here. Now let's look at the key money market instruments. Very, very important. Let's explore the main instrument of the money market. These are the tools. These are the tools used for short-term borrowing and lending, usually up to 1 year, right? So let's talk about it. So starting with the Treasury bill, or we call it T-bill. So when I say T-bill, these are the short-term government security with maturity of 91 days, 182 days, or 364 days, right? So they are issued at a discount and they are redeemed at the face value. So remember the two words: issuing at discount and redeemed at the face value. It means that whatever difference is there, it is your profit, right? Please remember it. And one more point is that since they are backed by the government of India, yes, government of India backed them, right? So they carry zero risk. Remember, this is the very important point. They carry zero risk, making them one of the safest investment, right? So Treasury bill, they are the safest investment. Then comes cash management bill, right? So please remember the next instrument we have is CMB, or cash management bill. They are similar to Treasury bill but with ultra short term maturity, which means less than 91 days. The government uses CMB to manage temporary cash flow management like short term gap between the income and the expenditure, right? This is called Treasury bill. CMB, cash management bill, right? Then comes the commercial paper, or we call it the CP. CP, they are unsecured short term debt instrument issued by corporate to raise fund for working capital need such as paying supplier or managing the daily expense. That is called commercial paper. So another important instrument is the certificate of deposit, or we call it CD. CD are the time deposit issued by the bank for a fixed period with guaranteed return. They are safe, they are suitable for short term investor looking for stability. CBLO, full form is collateralized borrowing and lending obligation. You can think of it as a secured lending platform where institutions lend and borrow short term fund against collateral, right? What institution do? They lend, they borrow what? Short term fund against what? Against the collateral, and the collateral is usually the government security. Then comes banker acceptance, in short we call it BA. This is the short term trade finance instrument where a bank guarantee payment on the behalf of a client at a future date. It is widely used in international and domestic market. So friends, let's summarize the key point which we have covered in this slide. We started with we are talking about all the kinds of short term instrument, right? All the kinds of short term instrument, T-bill and CMB. They are like government security, they are the safest option. Commercial paper, I told you that they are corporate short term borrowing. CD, they are bank issued fixed deposit with maturity. CBLO, they are secured borrowing or secured lending with collateral. And bankers acceptance, they are bank guaranteed trade finance tool. Right, these are the key points which we have covered. Friends, if you are looking for a study material for CTP examination, you can WhatsApp me on this particular number. You can get detail how to get access to the material. In the material, you will get unit-wise theory, unit-wise MCQs. Overall, 2000 plus MCQs are there, which caters the entire part: theoretical question, numerical question. Plus, you will also get previous year question paper through which you can gauge the level of examination. Right, now let's continue our discussion about the CMB. CMB already I think we have discussed, so this is the continuation part. Okay, some more points they have mentioned here. Let me just go through it. So friends, I told you there is money market instrument that is called CMB, or we call it cash management bill. So these are the short term security that the government issue. Why government issue? To manage temporary cash flow mismatch. The maturity is less than 91 days, making them ultra short term. They are very similar to Treasury bill, just issued less frequently depending on the government cash need. Then CP. CP means commercial paper. It is again unsecured short term promissory note. Again it is unsecured. It means it is a written promise by a company to repay money after a short term. Right. It is issued in the demat form. Please remember, dematerialized format we issue it, and generally at a discount, and it has a minimum investment of 5 lakh and is multiple of 5 lakh, right? There is no call, put or underwriting option in the commercial paper, which means once it is issued, it run till the maturity. That's called no call, put and underwriting option. Who can issue this commercial paper? Companies, NBFC, cooperative society with net worth of 100 crore or more and has a strong credit rating, they can issue this commercial paper. Please remember it. Now it can be bought by resident, it can be bought by eligible non-resident under the FEMA. These are the eligibility. The maturity period ranges from 7 to 270 days, and it can also be traded in the secondary market. One more point is that since it carries a bit more risk than government security, it generally offers higher return than treasury bill. Now let's look at the CD, or we call it certificate of deposit. These are the negotiable deposit instrument, which means they can be transferred, they can be traded before maturity. They are issued by the bank for 7 days to 1 year. And by the financial institution for 1 to 3 years. CD offer a fixed rate and the minimum investment amount is 1 lakh rupees and its multiple thereafter. They are ideal for institution or investor who want short-term, secure and fixed return. So what we learned from these two slides, let me just summarize. I told you that CMB are the government security, maturity less than 91 days. They are for temporary fund need. First point. Second point, I told you about CP or commercial paper. They are unsecured corporate debt for 7 days to 720 days, right? 270 days. And high return minimum amount is 5 lakh. Okay. And I told you the net worth of the issuer should be more than 100 crore. And CD I told you certificate of deposit. They are fixed term bank deposit, negotiable. Minimum amount is 1 lakh. And then I told you that all these things are short term, low risk instrument. Is used for liquidity management. Then we talked about the CBLO. Let's talk about the CBLO. CBLO is called collateralized borrowing and lending obligation. In short term, we can say that it is a secured short term lending and borrowing system, especially designed for institutions that can't participate in the call money market. Right? Secured short term borrowing and lending tool for non-call money participants. So it is designed for those institutions that cannot participate in the call money market. And the duration of CBLO can be as short as overnight and can go up to 1 year. Right? You can see the tenor, overnight to 1 year. And who manages the CBLO? CCIL manages. What is CCIL? Clearing Corporation of India Limited, under the supervision of RBI. Now one more point is that borrower provide government security or treasury bill, right, with at least 6 months left to maturity as collateral. And this collateral ensures safety for the lender. And the CCIL, Clearing Corporation of India Limited, matches lender and borrower and hold this security in the CSGL account, which is acting as a neutral secure intermediary. This CSGL account act like a neutral secure intermediary. If you look at the participant in the CBLO, bank, mutual fund, insurance company, pension fund, dealer, right? These are the participants. And since every transaction is fully collateralized, it offers higher safety and repayment right are transferable. You can see the keyword fully collateralized, repayment right transferable, giving it a great flexibility for all the participants. And banker acceptance, this one plays a key role in international trade. What is banker acceptance? It is a short-term trade finance instrument where a commercial bank guarantee payment on the behalf of its client. It reduces the risk in the trade transaction, especially when exporter and importer are different country. And this BA is issued at a discount to its face value. And maturity ranges from 30 days to 180 days. So what we learned from this discussion is that, let me just summarize. We started with CBLO, collateralized borrowing and lending obligation. These are secured lending and borrowing, which is done by a CCIL. Please remember the name. And it is collateralized with government security, tenure up to 1 year, and used by bank and financial institutions. Second, we talked about the bankers acceptance. In short, we call it BA. So they are the bank guaranteed short-term trade finance tool. They are used in the international trade, issued at a discount, 30 days to 180 days maturity, right? So both instruments promote liquidity, safety, trust in the short-term financial market. Now let's talk about the government security. So GSEC, so these are the debt instrument issued by the government. Government issues some kind of debt instrument that is called GSEC. Basically, when the government need money for development project, it borrow from investor through this security. Suppose government need money for what? For some development project. So what government do? It borrow from investor through these kinds of securities. These securities are called government securities. Please remember the name. In return, investor get a fixed or variable interest income. right? See, I'm again repeating, government need money for development project, so it borrow from investor through this security, and the investor get what? Fixed or variable interest income. Government security comes in two types based on maturity. The first type is called bond. So these are the long term security, usually more than 1 year, with interest paid every 6 months. That's called semi annual interest. The second kind of government security we have is T-bill, or we call it Treasury bill. These are the short-term security. They are issued for less than 1 year, right? And they are issued at discount, and they are redeemed at the face value, right? Please remember the keywords which I have just told you: bond, long-term security; Treasury bill, short-term security; bond more than 1 year; Treasury bill less than 1 year; bond interest paid every 6 months; and Treasury bill issued at a discount and redeemed at the face value. Please remember that all the government security are issued and managed by the Reserve Bank of India, right? And through the platform that is called eCuber platform. Remember the name, right? You know what is eCuber? It is a digital system for auctioning and maintaining this security. Now one more point is that Treasury bill auction are held every Wednesday, right? It held every Wednesday, and their maturities are 91, 182 and 364 days, or as per the quarterly schedule published by the RBI. Who can invest? So you can see bank, urban cooperative bank, primary dealer, insurance company, provident fund, right? They all can participate directly through the RBI account. Other investors, including individuals, can invest through demat account with bank or dealer. Now, when we talk about the dated government security, please remember these are long-term bond with either fixed or floating interest rate, and their tenor range from 5 to 40 years. You can think about it, right? So please remember it. And their interest is paid twice a year, that means semi-annual, making them suitable for investors seeking a stable income. Lastly, we have PDO, or we call it Public Debt Office, which plays a very crucial role. It serves as a registry and depository for all the government security, and it takes care of the entire life cycle from issuance to interest payment and finally redemption when the bond mature. So what we learned in this particular slide, let me just recapitulate. We started with the government security. I told you the key points related to the government security, that these are the government borrowing tool, bond more than 1 year, Treasury bill less than 1 year. Second point, I told you that RBI managed the government security issuance via eCuber platform. Treasury bill maturity, I told you 91, 182, 364 days, and bond it is 5 to 40 years. Interest payment is done semi-annually for bond, and discounted issue for Treasury bill. PDO, I told you, Public Debt Office, which handle registry, payment and redemption of the government security. Now let's talk about the types of government bond and some key insight related to it. Let's explore the different types of government bond we have. The various way the government borrow money from investor, and each one having the unique feature. So starting with the fixed rate bond, let's talk about it. So the fixed rate bond have a constant interest rate, right? That is also called the coupon rate, and this coupon rate remain the same throughout the bond life. This means investor know exactly how much interest they will earn, making it a predictable and a stable investment. That's called fixed rate bond. Then we have the floating rate bond, or we call it FRB. What happen here, that interest rate changes at a regular interval, or say every 6 months or every 1 year, and this FRB is linked to the benchmark rate, such as the repo rate, so that the return adjusts in line with the market movement. Then comes capital index bond. This protect your principal amount from inflation. The bond face value is linked to inflation index, meaning even if price rises, your investment value remain protected. That's called capital index bond. And then we have, taking it a step further, we have inflation index bond, which safeguard both principal and interest against the inflation. Their return are based on WPI and CPI, which is called wholesale or consumer price indices, ensuring real return is stay positive even during inflationary times. Next, we have bond with call and put option. A call option let the issuer redeem the bond early. A put option allow the investor to sell it back early. Some bond may have only one of these feature, while other have both the feature, offering flexibility to both the party. Then there are strips, which stands for separate trading of registered interest and principal of securities. It simply means that a government bond can be split into separate zero coupon part, right? One for each interest payment and one for the principal. That is called strips, separate trading of registered interest and principal of security, which means a government bond you can split into two separate zero coupon part. These strips are eligible for SLR, statutory liquidity ratio, if the original bond was, and are fully tradable in the market. Another popular instrument is the SGB, that is called sovereign gold bond. It is a gold linked instrument issued by the government but without holding physical gold. Each bond represents 1 gram of gold. An investor can buy up to 4 kg per year for individual and for HUF, while trust and entity can invest up to 20 kg per year. right? So limits I have just told you that 1 gram of gold, it bond represent 1 gram of gold. An investor can buy up to 4 kg per year, right? For individual and HUF. It's a great way to invest in gold without worrying about the storage or purity. Finally, government security are issued through auction. Auction can be of two types. What can be the two types? First way, it can be yield based auction for new securities where the yield is determining through bidding. And then we have the price based auction. What happens in the price based auction? They are for reissued security where investor bid on the price. So friends, let's recapitulate what we have covered in these two slides. So we started with the fixed bond. You remember we started with the fixed bond. I told you that fixed bond offer you a stable return. They are issued at a constant rate. That's why the name is fixed bond, fixed rate bond. Floating rate bond, I told you interest vary with the benchmark rate. Then I told you about capital index bond. So as I told you that they protect principal from inflation. Then we talked about IIB, inflation index bond, which means they protect both principal as well as interest. Then we have the call and put option, where we have early exit or redemption flexibility. Strips, full form just I told you, separate trading of registered interest and principal, which is split into tradable zero coupon part. Then we have the sovereign gold bond, SGB. So they are gold based investment, no physical gold is there. Auction mechanism, I told you, they are issued via yield based or price based bidding. Then we have the government security and bidding mechanism, very important. So basically there are two main types of auction. Already I told you, yield based auction and price based auction. Starting with the yield based auction, it is used when the new government security are issued for the first time. Here the investor place bid by quoting the yield. Yes, so investor what they do, they quote the yield. And what is the meaning of yield? Yield is the return that they expect. For example, they may expect 8.9% return or they may expect 8.20% return. In this system, the lower the yield, the better, because it means the investor is willing to accept a lower return, which is good for the government, right? Lower yield is better. And one more point is that once all the bids are received, the cutoff yield is decided. This become the coupon rate of the bond, and all bid equal to or below the cutoff yield are accepted. Then we have the second kind of bidding, that is called price based bidding, price based auction. So this is used for reissue of existing government security. So we have a government security existing and we want to reissue it. Then price based auction is used. Here bids are quoted in price per 100 rupees face value, right? Bids are quoted in price per 100 rupees face value. For example, 99 rupees or 100 rupees, right? In this case, higher price get higher priority, because the higher the price, the lower the yield for the investor. So bid equal to or above the cutoff price are accepted. Now there are two types of bidding method. The first is called competitive bidding, which is used by large institutions like bank, mutual fund, insurance company. They quote their desired yield or price and compete with the other. Then we have the other type of bidding, that is called non-competitive bidding, or we call it NCB. They are designed for retail investors who want to invest without getting into technical bidding. Yes, competitive bidding is used by the large institution. NCB is designed for retail investor. So NCB, these retail investors, they participate through aggregators or facilitators such as bank or stock exchange. In the context of competitive bidding, please note that the minimum bid is 10,000 rupees and the bid must be multiple of that amount. Investor can submit multiple bid at different price or different yield. However, allocation is made only if their bid is at or better than the cutoff yield or price. The non-competitive bid, is a big plus for individual investor. Why? Because it makes government security and treasury bill accessible to the general public, promoting the wide retail participation in safe government-backed investment. So let's just summarize the key point which we have covered in these two slides. I started with the yield-based, two types of auction I told you. Yield-based auction, please remember, for new issue, lower yield means better bid. Please remember these two words. They are yield-based auction are for new government security. And second point, the lower the yield, the better bid is. Right. Then we have the second kind of auction called price-based auction. I told you this is for reissuer, higher price, better bid. Competitive bidding, I told you that institution quote yield or price directly. Non-competitive bidding means retail investor participate via facilitator or aggregator. Encourage broader public participation in the safe government security. These are the points which we have just covered. Now let's come back to the next slide. Now friends, these are very important tool. Let's break down into simple terms, right? You can see the word conversion auction, OMO, buyback, LAF, etc, etc. So first of all, let's talk about the conversion or switch auction. You can think of this as an exchange offer between two government security, right? Exchange offer between two government security. The RBI allow investor to swap one government security, that is called source, for another, that is called the destination, through the e-courier platform. Right? See, swapping is happening. Swapping between what? One government security calling source, other government security calling destination. So we are swapping, source versus destination through what? Through the e-courier platform. And the price of the source bond must match the FBIL closing rate from the previous day. This keeps things fair and transparent. It helps the government manage debt maturity better and provide more flexibility in handling the repayment. So remember the keywords which I have just told you, right? Conversion auction is just like an exchange offer between two government security. We can swap one government security for another government security through the e-courier platform. And the source bond and destination bond. The price of the source bond, they must match with the FBIL closing rate from the previous day. It helps the government manage debt maturity better and provide more flexibility. So what we learned is that, that it is like refinancing old loan by swapping old security for new one at the current market rate. Then we have OMO, also called, open market operation. You know what it means? OMO, this is the RBI way of controlling the liquidity. Yes, or simply the flow of money in the economy. Right, the way through which RBI control the liquidity or the flow of money in the economy, that is called OMO. So see, when RBI, what happened? When RBI sells government security, it absorbs excess money from the system. And when RBI buy government security, it inject liquidity, adding more money into circulation. So this is the basic thing, right? So RBI buy to infuse money, use sell is to absorb it. Simple liquidity control is there. Then we have government security buyback. So the government, the government may buy back it old security for several reasons: to reduce interest costs, to improve market liquidity, to manage the cash flow. There are two main ways to do this. The auction method is there. This auction method is for large scale operation, and the second method is called NDS-OM, right? Negotiated dealing system, OM. So this is the secondary market for a smaller transaction. Even state government also do buyback to reduce their high interest burden or to meet condition of global lender like Asian Development Bank or World Bank. Each year a budget provision is kept aside for this purpose. So key takeaway is that buyback helps the government save money and keep the debt market healthy. Then we have the liquidity adjustment facility, in short we call it LAF. This is the RBI daily balancing tool for the bank. This LAF allows scheduled commercial bank and primary dealer, but not RRB. Please note that RRB is not there. It allows SEBI and primary dealer to borrow, to lend money overnight using government security or SDL as collateral. The goal is to maintain short-term liquidity, neither too much nor too little money in the system. So, this LAF keep the banking system daily cash flow stable and smooth. Then, so what we have covered in this slide, let me just recapitulate the key points. Please note it down. The first thing that I told you is that, conversion auction. Yes, we started with here, conversion auction, right? Let me just recapitulate. So you can see, yes, conversion auction. I told you that this conversion auction, this swap old government security for new one via a platform that is called e-courier platform, right? I hope you are familiar with this platform. The platform name is e-courier platform. Right. Second thing I told you that OMO. OMO means RBI buy to add money, sell to absorb money. Buyback means government repurchase old security to save on interest or to manage the liquidity. That is called buyback. And finally we talk about the liquidity adjustment facility, which is RBI daily liquidity control tool for bank as well as the primary dealer. Now friends, let's simplify some key RBI tools and account which is used for liquidity and government security management. First one we have is LAF. This is the RBI daily liquidity management tool. Bank lend money overnight with RBI using repo and reverse repo as the mechanism. It is also a short-term monetary policy instrument and the interest rate is set by the RBI. So what we learned from here, LAF, about LAF, I told you that LAF keep the banking system cash flow stable day to day. Then we have the marginal standing facility, or we call it MSF. It's like, emergency lending window for bank when interbank liquidity dries up. Bank can borrow against government security, but at a higher rate, that is repo plus 100 basis point. Each bank can borrow up to 1% of its NDTL or net demand and time liability. So what we just discussed that, MSF is a safety net for bank during liquidity crunches. Then we have SGL account, or we call it subsidiary general ledger account. This is an account maintained by RBI for the bank, primary dealer, select UCB and NBFC to hold and manage the government security. That is called subsidiary ledger account. Securities are either issued as stock certificate or securities are credited directly to the SGL with transferability recorded in the RBI book. And if you look at the short period, a short period is there currently 1 day, right? Short period means, a short period currently 1 day. when trading is prohibited, ensuring a smooth processing of maturing security. Then we have the gilt account. For investors who are not eligible for SGL account, a gilt account is maintained via the bank or primary dealer. So the custodian, they hold security on the behalf of investor using CGSL and SGL if account for SGL to account for settlement. So what we have covered in these two slides, let me just summarize. I told you about LAF. LAF stands for Liquidity Adjustment Facility. I told you that these are the daily liquidity management. How it is done? It is done via repo and reverse repo. Then I told you about MSF or Marginal Standing Facility. So these are the emergency borrowing for bank at repo plus 100 BPS. Maximum 1% of NDTL they can borrow, that is the limit. Then I told you about SGL account. SGL stands for Subsidiary General Ledger account, which means you can hold and you can transfer government security for eligible institution. Then we talk about the SUT period. SUT period is 1 day halt on trading to manage the maturity. And gilt account is for investors who are ineligible, who are not eligible for SGL. They are held via the custodian. Okay, some more points let's discuss now. We are just talking about LAF, MSF, SGL, gilt account, right? Now let's talk about the benefit of the gilt account. So these accounts allow investors who are ineligible, who are not eligible for SGL account. So these investors, they can hold government security electronically. What are the benefits? Like a smooth electronic management, right? For trading and maintaining security. Second benefit is maturity proceed and interest are first credited to the custodian RBI account and then promptly transferred to the investor account. And one more point is that gilt account make it easy and safer for non-SGL investor to hold government security. Then we have the NDSOM, or we call it Negotiated Dealing System Order Matching. This is a trading platform for government security which is owned by RBI, managed by CCIL. This is anonymous, order-driven system ensuring fair pricing and transparency. Direct access is available for bank, primary dealer, selected UCB, NBFC, other participate through the custodian. The key point is that NDSOM allow efficient. So DVP2 what it means that securities settle gross, fund netted, right? Securities settle gross term and fund is netted. Netted means what? Total payable or receivable consolidated. And DVP3 means both securities and funds are netted. Only final net positions are settled. So these are the three DVP system. So DVP system make trading safer by ensuring simultaneous transfer of securities as well as the money. So here we have talked about three things. First we started with the gilt account. I told you that gilt account benefits, electronic holding for non-SGL investor. It is safe, it is prompt, credit or proceed. Then we talk about NDSOM, Negotiated Dealing System Order Matching. Yes, it is managed by RBI, anonymous trading platform. It ensures transparency, right? And then we talk about DVP settlement, which means simultaneous transfer of securities and fund. Three times I told you, gross or net settlement, DVP1, DVP2, DVP3. Now friends, in the next slide, we break down the key trading and settlement concept in government security. So first of all, let's talk about the liquidity in settlement. There is something called, gross settlement, which means each transaction is settled individually. And it requires more liquidity. Then we have the net settlement, which means offset payable against receivable. It reduces liquidity requirement. So remember, netting help bank use less cash to settle the trade. Now when issued trading, point is when issued trading, WI trading. WI trading is when investor trade government security that are announced but not yet issued. Investor trade government security that are announced but not yet issued. Settlement happen only when security is actually issued, right? Now the key points is that WI trading, it allow early market activity, but final delivery depends on issuance. Then we have CCIL or Clearing Corporation of India Limited. They act like a central counterparty, or we call it CCP, for government security trades, reducing the counterparty risk. Yes, it reduces the counterparty risk. Settlement process we talk about, CCIL circulate net obligation for each participant, custodian to RBI via DVP, delivery versus purchase mechanism. Guarantee, I told you, if any participant default, CCIL cover it using margin and settlement guarantee fund, or we call it SGF. So CCIL ensure a smooth and secure settlement of government security trade. Short sale. Short sale means what? You are selling security not currently owned by the seller. Who are the eligible participant for this short sale? Bank, primary dealer, selected UCB. Friends, if you want to know in detail about these kinds of instrument, you can enroll in our course. Just in this particular video, I'm just revising the key points, right? But if you want to know in detail how it actually works like, I've explained in detail about this. You can enroll in our course to get more detailed knowledge. Now friends, we are talking about the short sale. Short sale means you are selling security which are not currently owned by the seller. Who are the eligible participants? Bank, primary dealer, selected UCB, they are the eligible participants. If you look at the limits, so if you have a liquid security, then maximum stock 2% of the stock or 500 crore, and for other security maximum 1% of the stock or 250 crore. Covering period, it means you must buy back within the 3 months, right? So remember, short selling is allow market activity but is regulated with limit and timeline. Then we have the repo and reverse repo. Repo means you borrow fund by selling security with an agreement to repurchase later, and reverse repo means from lender's perspective you lend fund against security earning interest. So repo and reverse repo is the backbone of short-term liquidity management and the money market. So what we have covered just now, let me just summarize. I told you about liquidity. Liquidity, what happened? That two types of settlement are there: net settlement, which means less cash required; gross settlement, which is more cash required. Then you talk about the WI trading, which means trade before issuance, and settlement will only occur after issuance. CCIL, I told you that this is the CCP or the central counterparty for government security, and it guarantees a smooth settlement. Then we talk about the short sale. Short sale means you are selling unowned security. And then you talk about the repo and reverse repo. So borrow or lend using security as collateral. Now let's simplify how repo and reverse repo transaction work in the money market. So if you look at the transaction structure, a repo has two legs. The first leg is for initial sale or purchase of security, and the second is for repurchase or resale after a short period. So the repo period is the time between these two legs, which is usually overnight. So two legs I told you, initial sale and then repurchase. The time between these two is called repo period. So repo is like short-term loan with securities are collateral. They are settled in two steps. Then we talk about the settlement. So repo transactions are settled like government security trades. First leg, the lender give fund, borrower provides security. Second leg, borrower repay principal plus interest, that's called the repo rate, and get back the security. So interest earned is the repo rate, representing the short-term borrowing cost. The purpose, if we talk about repo rate, repo rate allow bank and institution to borrow fund using government security as collateral. It provides safe and secured short-term liquidity in the market. So repo ensure that cash is available quickly while keeping collateral safe. If you look at the regulation and platform, please remember RBI monitors the repo market to ensure a smooth functioning. Transactions are executed via the CCIL and also reported via the CCIL. CCIL, Repo Order Matching Platform. It's called Clear Corp, right? Please remember the name Clear Corp. So this is point. Now let's quickly revise the key point which we have covered in these two slides. I told you about repo. There are two legs, right? Initial sale purchase leg plus repurchase leg. Repo period is usually overnight. Okay, settlement happen principal plus repo interest, and purpose is to secure short-term borrowing using government security. Platform is CCIL Repo Order Matching, which is regulated by the RBI. Name is Clear Corp. Then let's talk about the TREPS. So friends, tri-party repo. What is tri-party repo? This is the third-party agent who manage collateral, payment, settlement, custody, ensuring a smooth repo operation. So this tri-party repo, they make repo transaction easier and safer for participants. What are the key points? So tri-party repo reduce operational hassle by letting a neutral agent handle the mechanics. Right. If you look at the regulatory benefits, so tri-party repo are exempted from SLR or CRR calculation, freeing up the liquidity. And securities remain SLR eligible if statutory norms are satisfied. So let's discuss the key points that it offers regulatory relief while keeping security eligible for reserve requirement. TREPS full form is Tri-Party Repo Dealing System, right? So it is a platform for borrowing and lending under tri-party repo. And CCIL acts like a center counterparty and tri-party repo agent, TPA, right? So CCIL acts like a CCP and tri-party repo agent. This is operated by the Clear Corp dealing system, that is called CCDS. Who are the eligible participants in the TREPS? Public private bank, foreign bank, cooperative bank, financial institution, insurer, mutual fund, primary dealer, NBFC, corporate, provident and pension fund. They are the eligible participants in the TREPS. If you look at the functionality, they provide anonymous order matching for borrower and trader, and lending, and they offer real-time information, deals, volumes, rates, notification. So TREPS make tri-party repo trading transparent, efficient, accessible to multiple market participants. So let's summarize what we have discussed in these two slides. We started with the tri-party repo. I told you about tri-party repo key points, that third party manages the repo operation, third party manages the collateral. Regulatory, I told you they are exempted. Tri-party repo is exempted from CRR, SLR. SLR eligible if the norm met. TRDPS, I told you, tri-party repo dealing system. So this is the platform for anonymous repo trade, real-time data. CCIL act like a CCP. Then I told you participants are bank, NBFC, primary dealer, mutual fund, corporate, pension, public provident fund. Now let's talk about the trading opportunity in the money market. So money market is the market for short-term instrument with maturity less than 1 year. Common instrument include treasury bill, commercial paper, certificate of deposit, call money, repo, and banker acceptance. Who are the participants? So I told you that government, corporation, financial institution, retail investor, they take part in it. I think we have discussed this key instrument. I'm not going to discuss it once more. Right, this thing we have already covered. So let's skip the part which we have covered. Let's simplify how investor, how institution can trade in the money market and repo for profit and liquidity. So money market fund and secondary trading. So institutional investor, right, they manage what? They manage diversified, liquid, low risk portfolio. Who manage? Institutional investor manage. They provide higher return than saving account with easy entry, easy exit. Secondary market trading allow premature buying, premature selling, which adds in liquidity, profit taking, and tactical adjustment. So remember the key point that money market fund offer liquid, low risk profit with flexibility to trade anytime. Then we have the next point that is called profit potential in the money market. Very, very important. Arbitrage. What is the meaning of arbitrage? You exploit yield difference between treasury bill, commercial paper, and commercial certificate of deposit. And if you talk about the interest, quite safe, liquid security offer capital protection with modest return. And if you talk about the rate and liquidity bets, you buy when interest rates are expected to fall to gain the price appreciation. So remember the key points that money market trading can be profitable with low risk using yield difference and rate expectation. Then we have the risk consideration. Remember, overall the risk is low, but commercial paper carry more risk than government backed instrument. So the key point is that understanding credit risk before investing in corporate instrument. Repo trading opportunity. What is the meaning of repo? Which means you are selling a security with a commitment to repurchase at a higher price. So it is secured short-term borrowing. Types are two types: term repo and open repo. Term repo, which gives you fixed date for repurchase. Open repo, which is a kind of on-demand repurchase. Opportunity it provides like arbitrage, where you exploit cash future inefficiency. Right, and the second opportunity we have is funding and leverage, which means you borrow against security to enhance the return. Third opportunity we have is the short selling, which means you acquire security for delivery while securing funding via repo. So repo trading offer liquidity, leverage, arbitrage opportunity with minimal credit risk. So remember these key points. What I told you that money market fund, I told you that money market fund, they are liquid, they are low risk, they are flexible, secondary trading is possible. Then I told you about the profit potential. So arbitrage, interest gain, rate liquidity bet, risk, CP is riskier than the government security, and repo trading is secured borrowing, term open repo, arbitrage, leverage. These are the key points. Now friends, let's break down how the repo market work for hedging, who participate there, and the risk involved. Let's talk about the role in hedging and derivative pricing. Repo are used to hedge position like bond versus interest rate swap. So repo help establish market yield curve, and this market yield curve are very essential for derivative pricing and arbitrage opportunity. So remember, repo are not just borrowing tool, they also support hedging and market pricing. Who are the user, who are the participants? So it includes broker dealer, commercial bank, central bank, institutional investor, money market, mutual fund, and corporation. Central bank uses repo to implement monetary policy and to manage the liquidity. So technological age. So advanced platform, you must know the name, Broadridge ROQ. So they aggregate liquidity, they automate trade, they improve the efficiency, and they also enhance the profitability and reduces the operational friction. So remember, technology make repo trading faster, safer, more efficient. If you look at the risk factor, credit risk is the possibility of counterpart default, collateral valuation risk, which means price fluctuation of placed security. Then we have spread and rate volatility, which means it can cause losses if positions are unhedged. And finally, we have mitigation. So that repo are secured and regulated, reducing the exposure. So here we talked about 2 to 3, 4 points. Just let me recall. First, we started with the hedging. I told you that hedging means repo protect position, help build yield curve, right? Hedging. Then I told you about participants: bank, dealer, central bank, institution, mutual fund, corporate. They are the participants. Technology, I told you, these are the platform that automate, aggregate liquidity, boost efficiency. Risk, I told you, credit risk, collateral valuation risk, rate spread volatility risk, and they are mitigated by secured nature plus regulation. Let's talk about the CD, that's called certificate of deposits. It is a negotiable time deposit with fixed maturity as well as interest. It is issued in dematerialized electronic form or demat form, transferable after 45 days. CD is fixed term, transferable deposit in electronic form. Minimum amount, about CD, minimum amount is 1 lakh rupees or individual, and higher for institution. Tenure is for bank 7 days to 1 year, and for financial institution it is 1 to 3 year. Please remember it. Interest rate is fixed, which is market determined, unchanged during tenure. Liquidity, premature withdrawal may incur penalty, and buyback under some conditions. If you talk about the repayment, so principal and interest can be repaid at maturity. If holiday, you pay on the previous working day. What about taxation? It is fully taxable as per the Income Tax Act. And safety, it is regulated by RBI. If we talk about the eligibility of this for investing in this certificate of deposit, so it is available to individual, corporation, company, fund, NRI on non-repatriable basis. Please remember it. Non-repatriable means they cannot take back the fund to their own country. And bank cannot lend or buy back their own CD before maturity. Very, very important point. Advantage is that higher interest rate than saving account. It offer you fixed and guaranteed return. It is safe short to medium term investment. But disadvantage is that liquidity is quite low, penalty for early withdrawal, and interest rate is fully taxable. So remember the key points which we have just told you about CD. CD is negotiable, fixed term money market deposit, tenure is 7 days to 3 year, interest rate is fixed, eligibility is individual, corporate, NRI, non-repatriable basis. Pros are higher, safe and fixed return. Cons is low liquidity, penalties and taxable interest. These are the points regarding the CDs. Okay. Now let's talk about the IVPCs. That's called interbank participation certificates. So friends, it is a short-term money market instrument that let bank share the loan asset. Key point is sharing the loan asset. It helps bank manage liquidity and to meet the statutory lending target. So the key point is, it is IBPC, they are the bank sharing loan to balance liquidity and regulatory requirement. If you look at the types of IBPC, we have with risk sharing, which means credit and interest rate is shared between the bank. Tenure is usually 91 days to 180 days. It counts for priority sector classification if underlying loan qualify. Then second part we have is without risk sharing, which means only the loan asset is transferred, risk is not shared. That's why the word is without sharing. Maximum tenure is 90 days. So IBPC can share or not share the risk depending on the structure. If you look at the key features of it, so participant include a scheduled commercial bank including RRBs. What is the purpose? The purpose is to manage short-term liquidity and to comply with the PSL target, that is priority sector lending target. And limit is less than 40% or equal to 40% of the loan account outstanding. If you look at the accounting, please remember, if it is with risk sharing, issuer reduces advance, participant shows as advance. Without risk sharing means issuer shows as borrowing, participant shows as interbank advance. Interest rate are mutually agreed between the terms. If we talk about the repayment, principal plus interest are repaid at maturity and risk loss shared proportionally. A statutory treatment, please remember it, it counts toward NDTL, net demand and time liability. The benefit is that it is quite effective tool, very much effective tool for monetary and liquidity management. It helps bank meet priority sector lending target. So let me just recapitulate the key points about IVPCs. I told you that banks share loan for liquidity and regulatory target, sharing of the loan. Two kinds of sharing can happen, with risk sharing, without risk sharing. So with risk sharing 91 to 180 days, without risk sharing means only asset is transferred, no risk is shared, which is for less than 90 days. Participants here include a scheduled commercial bank and RRB. And limit is, I told you, less than 40% of the loan account outstanding. Purpose is to ensure liquidity, priority sector lending. This is the purpose. Okay, if you see the comparison, if you compare the CDs and IVPCs, let's have a look. What is the key difference? Very, very important. So let's break down the difference between the certificate of deposit and the interbank participation certificate. CD is a time deposit with a fixed return, mainly an investment tool. But IBPC is a loan asset sharing instrument which is used by bank for liquidity management and priority sector lending. So remember the keywords: CD is for investment, IBPC is for interbank liquidity tool. Second point is regarding the issuer. So remember, CD is issued by the bank and financial institution, while IBPCs are issued by the scheduled commercial bank including RRB. If you look at the tenure, so CD tenure is 7 days to 1 year. for bank, 1 to 3 year for FIs, and IBPC tenure is 91 to 180 days risk sharing and less than 90 days for non-risk sharing. Transferability, CD, they are freely transferable after 45 days, and IBPC, they are transferable only among the participating bank. No external transfer can happen. So remember, CD can be traded, IBPC cannot be traded. If we talk about the risk, so remember, CD risk is very low. They are regulated by the RBI, while IBPC risk depends on the type, which may be shared risk or non-shared risk. So remember, IBPC carry credit or interest risk, but CD are quite safe. If you look at the purpose, so CD investment with fixed return, and IBPC, they help bank manage liquidity and priority sector lending target. Taxation, CDs are fully taxable as per the income tax law, while IBPC are taxation not applicable to the end investor. Secondary market, CD can be traded in the money market, while IBPC are not traded, strictly interbank. Right, so that is the point. And one chart they have given you for your understanding purpose. Now let's talk about the refinancing as a source of funding. What is the meaning of refinancing? Refinancing means you are replacing an existing loan with a new one under better or adjusted term. Right, so the key point is refinancing means you are swapping old debt for a new one with improved terms. If you look at the purpose of refinancing, it reduces our borrowing cost with lower interest rate. It consolidates multiple loan into single manageable repayment. It adjusts repayment tenor to match financial capacity or market condition. You can access additional fund for operation, investment or working capital. So remember the key point that refinancing improves cost efficiency, repayment convenience and liquidity. If you look at the type of refinance, we have personal refinancing, we have corporate refinance. What is the meaning of personal refinance? So this is done for mortgage, auto loan, student loan. And what about corporate refinancing? This is restructuring or replacing corporate debt for financial and operational flexibility. If you look at the key points, just remember that both individual and company can refinance to manage the debt better. If you look at the key features, so please remember that new loan pay off old debt, interest rate, tenor and repayment rate get reset. Approval depends on the borrower credit worthiness and the market rate. And bank refinance using saving deposit, interbank loan, bond or equity to maintain the liquidity. If we talk about the export refinance, so this is the facility by the central bank, that is RBI, for commercial bank against the outstanding export credit. It supports pre-shipment and post-shipment export financing. So refinance, which means replacing old loan with a new better terms. Purpose is lower cost, consolidate debt, adjust tenor, access fund. Types are personal and corporate. Export refinancing, just now I told you. Now let's talk about the export refinancing and NABARD refinancing. So export refinance means you are supporting export by providing bank with liquidity. That is called export refinance. You are providing bank with liquidity. That's why you are supporting the export, right? And it enable exporter to get cheaper and timely credit. Because bank feels secure to lend to them. Why? Because they have access to the refinance. Right, so it helps exporter access fund quickly at lower cost. If you look at the type of exporter refinance, we have pre-shipment refinance, which means fund used for purchasing, processing and packaging the goods before export. So goods has not been exported yet, right? So the fund which we use for purchase, for process and to repackage before the export, that's called pre-shipment refinance. And post-shipment refinance means, so it covers the gap. There is a gap between the shipment and realization of the export proceed. So that gap is covered by the post-shipment finance. So remember, pre-shipment means before export, post-shipment means after shipment. Mechanism is very simple. That central bank decide the refinance percentage of the eligible export credit, let's say 15 to 50%. They offered at a favorable rate, and this rate is linked to the repo rate. They are repayable on demand or within 180 days. No margin is required. It is subjected to minimum drawdown and procedural norms. Eligibility, I already told you that authorized foreign exchange dealer, right? Only eligible outstanding export credit are there. Only eligible bank and credit can access refinance. Then we talk about the NABARD refinance. I told you this is an apex rural development financial institution in India. It provides refinance to bank. It provides refinance to financial institution that support rural development project. Yes, it is quite focused on the rural development project. Now let's talk about the SEBI refinance. So first of all, before that, let me just give you some points about NABARD refinance. So NABARD boosts resources of eligible bank and institution for agriculture, allied activity and rural development. It helps bank lend more to farmer and rural project. Eligibility, if we talk about, so who can avail this NABARD refinance? A scheduled commercial bank. 18 to 15 year, right? Refinance loan period. Repayment is quarterly. Interest is monthly or quarterly. Extent of refinance can be 90 to 100% of the eligible loan depending on the purpose and location. If you look at the security, as per the general refinance agreement, it includes bank mandate and board authorization. So remember the key points: long-term loan, mostly fully covered with formal security agreement. Some special scheme if we talk about, targeted funding for PACS, water, sanitation and similar rural initiative. So remember the key points. NABARD also support priority rural program. If you look at the SEBI refinance, so SEBI is the key institution for promoting, financing, development of MSME, that is micro, small and medium enterprise. So remember, SEBI refinance is funding support for MSME via bank and financial institution, right? So what are the objective of SEBI refinance? I think you know it. To boost the credit flow to MSME who are eligible: a scheduled commercial bank, a small finance bank, RRB, urban cooperative bank, they are eligible. Who are the borrower? Who are eligible borrower? MSME is borrower having Udyam registration, microfinance loan for non-farm generating activities. And terms, this refinance cover outstanding asset of the previous 12 months, lending rate capped above the external benchmark, repayment period is up to 3 years or till underlying loan maturity, and security, collateral for underlying loan held in trust with SEBI. This is the security. Penal interest apply for default. It is subject to sectoral exposure norms. Yes, obviously there is a limit. You have to get that limit. So that is all we have to cover in this module number B. I hope if you go through this video once more, right, every point will be clear. I have explained the same thing twice, right? You see now, for once I explain the concept, and then after explaining that I just recapitulate. Please watch the video till the end and you will be able to memorize all the points in just 60 minutes. So let's get started. First of all, let's quickly understand what treasury management in the simplest way possible. Right now, first of all, treasury management simply means managing money, which means how fund comes in, how they go out, how they are used efficiently. It is mainly seen in government, bank and big companies, right? The main goal is to make sure that there is enough liquidity, that means enough cash flow for a smooth financial operation. Now friends, the government plays the foundation role in the context of treasury management. So it is responsible for creating currency through printing notes and minting coins, which become the base of all the monetary transaction in the country. Now if we talk about the nationalized bank like SBI, they act like an agent of the government. They handle important functions like collecting government revenue, making payment on the behalf of the government. Now friends, let's come the RBI. RBI is called Reserve Bank of India. They act like a bank to the government, right? They issue currencies, they manage public debt, they regulate credit in the economy. Through this function, RBI ensure overall monetary stability in the country. Now friends, in the corporate world, treasury management focus on maintaining the daily cash flow. It manages inflow, it manages outflow of money to ensure financial stability and a smooth business operation. So here is the quick difference. Treasury management deals with government level cash and credit operation. Fund management on the other hand is about business level finance, how company handle their fund. Now RBI is also responsible for currency operation. It issues notes, it distributes coins, even the small denomination. It manages the currency circulation on behalf of the government. So in short, we can say treasury management is all about managing money wisely, whether at the government level, banking level or business level. And its aim is very simple: to ensure that funds are available, stable and used efficiently. So that is about the treasury management, basics of treasury management. Now friends, we will quickly revise the treasury and finance, right? So these are the easy to grasp points that help you understand how money actually move within the bank, business and the economy. So currency chest operation. So friends, if you are preparing for the CTP examination, obviously you are, and if you are looking for notes, PDF, unit-wise theory, 2000 plus MCQs for practice purpose, as well as the previous year memory boost question, and this type of short notes to help you revise the entire content, you can WhatsApp me on the number shown on the screen, or in the description section of the video you will directly get the course link. You can enroll in the course and start preparation. Now friends, let's continue our discussion regarding the currency chest operation. What I told you, bank keep their extra cash in a special vault that is called currency chest, and this currency chest is maintained by the RBI. So when bank have excess cash, they deposit it here. Whenever bank have excess cash, they deposit the money in the currency chest, and when they need cash, they withdraw from it. So these chests basically help the RBI control money supply in the economy by expanding or contracting the amount of money in circulation. Then comes, currency backing and evolution. Earlier, money was backed by gold and silver, but now it is supported by the government securities and promissory notes. Over the time, paper currency have replaced metal coins, and smaller coins started being made from base metals like copper, like zinc. Also, the use of credit instruments such as promissory notes helped boost trade and commerce, making transaction much easier. Now, if we talk about the scope of treasury management, so it covers everything related to cash, currency, bank fund, liquid investment like government security or mutual fund. In short, we can say that it's all about managing the flow and investment of the money efficiently. Then we have the core banking, core business operation. So every business run on three main functions. First one is the production. Production means what? Creating goods, creating services. Second is the marketing. Marketing means promoting and selling the products. And finally we have the finance, which means managing the money required for both production as well as marketing. So these are the three main functions of every business: production, marketing and finance. Production means creating goods and service. Marketing means promoting and selling them. Finance means managing the money required for both the operation. Now if you look at the function of the finance, so finance function ensure that there is enough money available for all business activity. Now it looks after the long term fund. What is a long term fund? For example, you take the case of fund needed for project or a business expansion. That is a long term fund. So this finance operation looks after the long term fund. The finance function also involve forecasting the future need and prioritizing expenses so that a daily operation run smoothly without liquidity issues. So see, three functions I told you about finance: ensuring fund and ensuring that there is enough money available for all business activity. Second thing, it looks after the long term fund. Third thing, it also involves forecasting the future need and in prioritizing the expense. Now treasury as a finance, here's the simple difference. A finance manager, he focus on arranging the funds, most likely long term fund, right, like loan or investment for big project. That is the role of finance manager. Whereas a treasury manager, they handle the daily cash flow, making sure that there is enough liquidity to meet the short term needs. That's the difference between a finance manager and a treasury manager. Finance manager focus on the long term fund, while treasury manager focus on the daily cash flow, right? Both are crucial for maintaining the financial stability and performance of an organization. So to summarize, we can say that finance is about arranging the fund, while treasury is about managing them efficiently on a day-to-day basis. I hope you can recognize the difference. Finance is all about arranging the fund. Treasury is all about managing those funds efficiently on day-to-day basis. Together they form the backbone of any organization financial health. Now friends, let's switch our focus to understanding the micro and macro treasury perspective and their objective in super simple terms that are easy to remember for examination. First of all, dual level of treasury. Treasury work at two levels: micro level and macro level. At the macro level, the government and the large business manage overall cash, credit and financial instrument. At the micro level, individual business unit look after their day-to-day fund management, basically ensuring that money keep flowing smoothly for operation. That happened at the micro level. Now if we talk about the macro level operation, so at the macro level, when saving in the economy are less than, see, two things can happen: saving is less than investment, right? So at the macro level, what happened when saving in the economy are less than the investment? The government or the big corporate raise money by issuing securities or promissory note. See what they do, they issue security, they issue promissory note, right, at the macro level when saving is less than investment. On the other hand, when there are surplus saving, which means saving exceeding the investment, right, from where saving can arise? From household or foreign investor saving can come, right? So on the other hand, when saving is larger than the investment, then that money is used to fund those borrowing. Right? See, this is the macro level operation. Two things can happen: either saving can be less than investment. When saving is less than the investment, government or big corporate raise money by issuing security. On the other hand, when they are surplus saving, like from household or foreign investor, the money is used to fund this borrowing. In short, we can say treasury ensure that there is a proper balance and financial stability by managing this inflow and outflow effectively, right? This is called inflow and outflow management. So now at the micro level, that is within the business, funds are used to expand production, to support distribution and to support the consumption activity. Three words are there: expansion of production, supporting distribution and consumption activity. When business earn profit, when business generate revenue, these are paid back to the system in the form of taxes, in the form of loan repayment, right? So that is a micro level. Micro means what? Whenever business earn profit, whenever business generates surpluses, So these, these are paid back to whom? To the system in the form of tax and loan repayment. The role of a finance manager is to maximize the asset, minimize liability, and to increase the profitability. Now let's talk about the need for coordination. Both treasury and the finance function must work in a sync. They must work in a synchronology. Why? Because the finance function focus on the long-term asset management. Again and again I am repeating. See, this is a very, very important thing. Finance function focus on the long-term asset management, long-term asset planning, whereas the treasury function on the other hand looks after the short-term fund flow. When I say short-term fund flow, it means managing liquidity on a daily basis. Together, they aim for economy, efficiency, productivity, the three pillars of a strong financial management. I hope it is crystal clear. Now friends, let's talk about the main objective of the treasury management. To make sure that there are adequate funds for daily operation. To arrange money either from internal source like revenue or external source like loan. To ensure timely availability of fund so that business never stop. To deploy fund in the right amount at the right time for maximum efficiency. And finally, to maintain the financial stability, right, and achieve optimal return by using the fund wisely. So in short, we can say that macro treasury keep the economy stable while micro treasury keep business running smoothly, right? So tell me, if I ask you which economy keep the economy, which treasury keep the economy stable, answer is macro. And if I ask you that which treasury keep business running smoothly, it is micro. The goal of both is simple: to ensure that there is enough fund, there is enough money at the right time, at the right place for the maximum efficiency and financial stability. Do hit the like button if you think that this video is adding value to your preparation. Now friends, let's welcome back. Now let's talk about now we will understand how efficient treasury operation work. We will focus on fund control, timely availability and profit optimization in a clear and practical way. Now let's talk about the fund control and optimization. Efficient treasury management starts with controlling and optimizing the fund. The main idea is don't keep too much idle cash lying around. Why? Because surplus fund leads to opportunity cost. Yes, if you have surplus fund, opportunity cost will arise, which means that money could have earned profit elsewhere. So, treasurer, they must maintain precise cash tracking. They should always know how much money is coming in, how much money is going out. It's also important to keep a contingency margin. Yes, very, very important to maintain this contingency margin. What is contingency margin? It's like, a small reserve for emergencies or unexpected expense. That is called, contingency margin, like a small reserves, right? For emergency or unexpected expense. And when we say cash, it does not only mean physical currency. Cash does not mean only physical currency. It includes bank balance, it includes liquid security, right? So those are investment that can be quickly converted into cash when required, right? So cash does not mean only physical currency. It includes bank balance also, it includes liquid securities also. Now the next point is timely fund availability. The second goal, see, what you're talking about, again I'm reminding you, we are talking about the treasury flow, treasury operation work, right? So first thing I told you, fund control, right? Fund control. Second point is timely fund availability. Let's discuss it now. How it control. So the second goal is to ensure that funds are available exactly when required, not too early, not too late. There are two main sources of fund. One is the capital receipt, like loan or the money from selling the asset, disinvestment that we call it. So they are predictable. You can predict that. Yes, they are predictable. However, on the other hand, if we talk about the revenue receipt, like income from sale, income from service, they are less predictable. So in terms of predictability, capital receipt are more predictable, right? That's why treasury teams must do rigorous cash flow planning. Rigorous cash flow planning is required to make sure that money comes in on time. They coordinate closely with the finance department. With they means whom? Treasury department. Treasury department coordinate closely with the finance department for capital fund and marketing department for revenue inflow to mobilize fund effectively. You can see now the close coordination between all these departments, right? It is inseparable. Now friends, following a planned schedule for receiving fund, they help maintain a smooth operation, steady inflow of the cash. And remember, both domestic and foreign currency, they are treated equally for fund management. There are no regulatory barrier in this context. The third important function is the fund management and profit optimization. Friends, once funds are available, the next step is deploying them efficiently. This means deciding where the money should go, whether for routine operation, whether for temporary investment, or whether for capital expenditure. When we talk about capital expenditure, it is used for buying long-term asset like machinery or building. So these are the things that are not done every day. And when we talk about revenue expenditure, see, receipt we have already talked about. Now we are talking into the context of expenditure. So when you talk about revenue expenditure, it means it covers regular operational cost like raw material cost, wages, daily expense. Treasury manager must continuously monitor the receipt and maintain a prioritized disbursement schedule, ensuring that payments are made based on urgency and importance. So ultimately, these three things help the organization use its fund smartly and maximize the profit without facing liquidity issue. So to summarize, we can say that, efficient treasury operation are all about using money wisely. Control your fund, make sure that they are available on time, and deploy them in the right place. That's the formula for a smooth operation and stronger profitability. And where to deploy the fund, I just told you, capital expenditure are there, revenue expenditure are there, right? So that is the point. Now friends, let's talk about the Basel III. Yes, we are talking about the Basel III and Treasury compliance. Friends, this Basel III is a very hot topic for CTP examination. They ask question in one form or another. So we will break down the key Basel III norm, capital buffer, transfer pricing, and core treasury term in simple, easy to understand language. First thing is that, Basel III was introduced to make the global banking system stronger and more stable after the 2008 financial crisis. So Basel III increased the capital requirement for the bank. As you can see, common equity was raised from 2 to 4.5%. Earlier it was, in Basel II, common equity was just 2%. Rather, it was raised to 4.5%. Tier 1 capital went up from 4% to 6%. So this means that bank now need to hold more high liquid, high quality capital to protect themselves from financial shock. Yes, you can see in a common equity they have raised to 4.5%, tier 1 capital they have raised to 6%. Then Basel III also introduced two important buffer, that is called CCB, capital conservation buffer, triple CB, counter cyclic capital buffer. So these help bank absorb unexpected losses and maintain stability during the tough time. Now for treasury manager, this means that they must align their fund management practice with the evolving Basel III requirement to ensure the full compliance. If we talk about the additional Basel III and transfer pricing insight, so counter-cyclic capital buffer, or we call it triple CB. So this is an extra capital reserve, right, that banks build up during the good economic time. So the extra capital reserve built by the bank during the good economic time, this is called triple CB. It helps offset the ups and downs of the business cycle, especially when earning fluctuate, right? This triple CB, it helped the bank it help offset the ups and downs of the business cycle. The range of this triple CB is decided by the national authority, and it usually lie between 0 to 2.5% of the RWA. 0 to 2.5% of the risk weight asset, right? And yes, it is funded through tier 1 capital, tier 1 equity capital. Please remember it. From where funding of this triple CB is done, it is being funded through the tier 1 equity capital. Now transfer pricing, it means setting the internal transaction price for goods and services exchanged between different branches. In a bank there are different branches, and goods and services are constantly being exchanged between the branches. So what should be the price, right? So we set the internal transaction price. That's called transfer pricing, right? So suppose goods and services are being exchanged between the branches, between the departments, between the subsidiary of the same organization. In that case, the pricing, what should be the internal transaction price, right? That is called transfer pricing. It is used for accounting and taxation purpose, both in domestic and international operation. In the treasury context, this transfer pricing help bank allocate liquidity cost fairly between the departments. Yes, that is how it is used. It help in allocating the liquidity cost fairly between the department, ensuring better performance measurement. Then we have some key concept like ALM, asset liability management. The function is basically, this is the function, right, which balances the bank asset and bank liability. So on one side we have asset, other side we have liability. We want to balance both of them. Why we want to balance? Because we want to reduce the risk of mismatch. Like when loan repayment and deposit don't align in timing or values. It happens most often, right? Loan repayment as well as the deposit, they don't align, right, in timing. They don't align in value. They don't align in timing. Then ALM is required. We need to balance the bank asset and bank liability, right? Second case, we have Basel record. What is Basel record? Basel Accord are the global standard for banking regulation developed by the Basel Committee on Banking Supervision, that is called BCBS. Why Basel Accord comes to picture? Because to promote financial soundness across the country. That is why Basel Accord comes to picture. Now you can see the evolution 1 to 2 to 3. So let's see the how Basel framework evolved. Right here, evolution has been shown here. So Basel 1 focus on the minimum capital ratio. Right, Basel 1, the main focus of Basel 1 was the minimum capital ratio. What Basel 2 focused on? Supervisory review and risk assessment. While Basel 3 went further, strengthening the liquidity buffer, strengthening the capital quality, and risk management standard. These are the three Basel 1, 2, and 3. Now friends, basically let's talk about the CCB, that's called capital conservation buffer. This is a mandatory reserve that bank build up during good times. Yes, bank builds a mandatory reserve during good time. It's act like a cushion, allowing bank to absorb loss and stay strong during financial stress or crisis period. So to summarize the point which we have covered just now, please remember these points. Basel III makes banks safer by demanding higher capital and buffer liquidity. CCB and triple CB, they act like a safety cushion. ALM ensure balance between asset and liability, and transfer pricing help manage internal fund cost effectively. All of these together strengthen both treasury operation and overall financial stability. Now let's talk about the economic sector. So basically economy key, if you look at the key economic sector, so economy driven by government, business and foreign sector. All depend on cash, currency and credit for a smooth operation. Now friends, industries and business, they need financial access, including foreign exchange facility. It is very much essential for production, for import and export. Now continuous circulation of fund through taxes, saving, investment, loan repayment, that is called fund flow cycle. It keeps our economic operation active and sustainable. Now friends, long-term fund they are sourced from either equity, which means owner's capital, or debt, which means borrowed capital. Right, so from where we can source the long-term fund? Either we have equity or we have debt. They are required for infrastructure creation and project setup. If you look at the working capital need, so these are the short-term fund which are used for raw material, utilities and wages and day-to-day production cost. What is the role of treasury management? See, it manages the finance at both the macro level and micro level. It ensures a steady flow of cash and credit. It aims for liquidity, profitability as well as stability. If you look at the borrowing mechanism, government and business often borrow beyond current mean. Instruments which they use are security, equity, shares, promissory notes, treasury bills. These are the instruments being used, and they are financed by the household saving and foreign sector surplus. Now friends, let's talk about the corporate treasury and international finance. So friends, household and foreign sector generate surplus fund. Household and foreign sector, they generate surplus fund. When I say surplus fund, it means their income is more than expenditure, right? And these surpluses are channelized to the micro unit. Right, these surpluses are channelized to the micro unit, supporting production, distribution, consumption and growth. Right, now if you look at the holistic corporate operation, so corporate success depends on two things: financial asset plus human resource. It involves both tangible and intangible. When I say tangible, it means like capital, it means like asset, and when I say intangible, it means innovations, efficiency. So this holistic corporate operation, it combines both financial and both tangible and intangible. Right. So I have given you example of tangible and intangible. Tangible means something that you can measure, capital, asset, etc. And one more point is that this holistic corporate operation, it impact forecasting, goal targets, and goal settings and long-term performance. What is the role of treasury manager? He handles daily cash flow, fund allocation, liquidity planning. He or she monitors financial stability of the firm and indirectly support economic balance. And they have a key link between corporate operation and the financial system. If you look at the source of fund, there can be two sources: internal source or external source. Internal can include retained earning, depreciation reserves. These are the things under internal. And if you look at the external, it includes so internal, I have given you example, retained earning and depreciation reserve. External includes capital market like shares and debenture, money markets like corporate paper, commercial paper, certificate of deposit, interbank borrowing under the money market. And it also includes some foreign source like external commercial borrowing, FDI, trade credit. These are under foreign source. So fund structure follow national and sectoral pattern. So just now I have told you the sources of fund. It can be internal, retained earning and depreciation reserve. It can be external, capital market and money market, foreign sources. Now if you look at the international financial market, so they are originated from the global trade expansion and sectoral independence. Modern economy are financially interconnected. No nation is fully self-reliant. The result is that cross-border capital flow is there and international treasury operation is there. How do we do the fund allocation? So fund deployment varies for domestic operation and international operation. If we have domestic operation, then they focus on working capital and short-term needs, and if there are international operation, it includes long-term investment, forex exposure measures, and this multinational company maintains separate plan for current and capital expenditure. Now let's look at the multinational financial flow. Parent companies fund subsidiaries, branches abroad, right? Parent company, they fund subsidiaries and branches which are abroad, and they manage inward remittance like working capital, FDI, trade inflow. They also manage the outward remittance like dividend, royalties, technical services fee. This multinational financial flow is central to global liquidity management and currency risk control, right? Now let's talk about the treasury management scope and goal for global financial integration. So let's understand the scope of it. Global financial market were created to support international trade and finance. That is why global financial market was created to support what? International trade and finance. In today's world, economies and corporates are quite interconnected, right? So that fund move freely across border for business, investment and trade. So these market help country and company borrow, invest and manage risk globally. So that is the purpose of the global markets. If you look at the micro and macro interlinkage, you can see that treasury management work at both micro level and macro level. At micro level, treasury management deals with company day-to-day fund flow. But these small level decision when added up, they affect the broader economy. It's not that their role is not important. These kinds of small level decision that we take when added up, they affect the broader economy. Right. And what are the macro level? It includes interest rate, liquidity, overall financial stability. So treasury decision taken by individual firm can impact the nation and even global financial system because they are quite interconnected right now. If you look at the role of the treasury manager, so he is like financial heart of a company, right? So basically they manage cash flow, cash inflow, cash outflow, investment, funding needs. They face competition just like the business unit, but their role ensure that the organization runs smoothly without financial stress. Then we have something called interconnected economic environment. So what it is all about, let's understand. Today corporate world is deeply linked with the domestic and international market. That means a treasury manager must understand not just the Indian finance but also how global interest rate, how currency value, how capital flow affect their company. Because if there is any changes in the outside economy, it will have surely impact on our Indian economy also. That is why understanding these things is very much crucial. Understanding domestic international system is very much crucial. If you look at the scope level, the scope of treasury management work on three level. At the unit level, it means managing fund within the company, making sure that money is available for operation. At the domestic level, it means coordinating fund with the national financial system, or we call it NFS. And at the international level, it means managing global transaction, right? Currency exposure, cross-border funding. So these are the three level of treasury management. Unit level, funding within the company. Domestic level, funding within national financial system. Then we have the unit level responsibilities. At the company level, treasury ensure a smooth flow of fund for all the function, production, marketing and HR operation. Remember, fund are the lifeline of every organization. Without proper fund flow, even a profitable company can face financial trouble. Friends, using our material, many aspirants have cracked the CTP examination in previously held session. So you can also enroll in the course and get better research result by just enrolling in our course. Now let's talk about the budgeting role. So the treasury plays a key role in budgeting and financial planning. How? Because it helps in preparing and controlling financial, costing and marketing budget, making sure that resources are used efficiently and that the company maintain a healthy cash balance. So in short, we can say that treasury management connect the company internal fund flow with the national and international financial environment. It ensures liquidity, stability as well as profitability. Now friends, we will learn how about the treasury management at the company and domestic level. At the company level, treasury management, treasury ensure that the money flow efficiently and support all the operation like budget alignment. So treasury manage financial, marketing, HR budget and ensure that they match the company performance goal. Then treasury management constantly monitor the money coming in, money going out. During cash shortage, it prioritize urgent payment to keep the operation running smoothly. And treasury work closely with production and the marketing team. It takes feedback from different departments to ensure that funds are used optimally. Then we have the domestic level treasury management. So at the domestic or national level, treasury management ensure that public saving, bank operation are efficiently directed. Like saving from the household and business are channeled into profitable investment through the commercial bank. Second point, treasury is overseas borrowing, lending, investment activity. Bank also earn revenue from cash and near cash transaction. ALM I have already told you, asset liability management. So bank align their short and medium term liability with asset, right? Based on maturity and cost. Bank basically ALM ensure that bank is still liquid and financially stable. So in short, company level treasury focus on efficient fund use within the organization, while domestic level treasury ensure public saving and banking operations support on the overall economy. Right. So domestic domestic treasury ensure that public saving and banking operations support the overall economy. Right. Both level are essential for liquidity, stability, and growth. Now, friends, we will cover regulatory requirement for bank and government securities management. So bank must follow a strict rule to ensure that financial stability and public trust. So compliance, bank must maintain capital adequacy, provision for NPA, meet the CRR SLR requirement. If you look at the CRR means what? A portion of the deposit it kept with the RBI to control the liquidity. Yes, a portion of the deposit it kept with the RBI, that's called CRR, cash reserve ratio. SLR means statutory liquidity ratio. Bank invest in the government security to maintain stability and liquidity. So that is called SLR. Right. Now strategic investment. What is the meaning of it? Sometimes what happen, when the loan demand is very low or interest rate decline, in that case bank can invest beyond a statutory limit. So strategic investment means what, when loan demand is low or interest rate decline, bank can invest beyond a statutory limit. This allow bank to benefit from price appreciation in the government security and earn higher interest. There is something called gilt age market structure. The government security market is called the gilt age market because of its highest safety and stability. So there is primary market where RBI manage the wholesale sales of the government security. Secondary market which called over the counter retail trading among bank, financial institution, right? And finally we have the repo. RBI facilitate repurchase agreement at the market driven rate to maintain the liquidity. Now if you look at the primary market operation, what happened, RBI sell government security to bank. I think we have discussed this. Central government security are underwritten by RBI if subscription falls short, and state government security subscription are facilitated by RBI only. Now secondary market dynamic, I told you that securities are traded over the counter via phone or faxes. Key participants includes DFHI, bank, financial institution, and PFs, pension funds. Then we have yield concept. Yield is the return of investment. Bank loan yield depends on interest payment frequency and market condition. Right. So in short, we can say that bank follow regulatory rules like CRR, SLR to stay safe, invest strategically in government security, participate in the primary and secondary market. RBI plays a central role in managing liquidity, stability as well as the return. Now, when you invest in a government security, you can measure return in different way. The first term you have is the nominal yield. Nominal yield is the basic return. How to calculate it? Coupon rate divided by purchase price. That will give you the nominal yield. Coupon rate in the numerator, purchase price in the denominator. That will give you the nominal yield. Real yield means what? It adjusts the nominal yield for inflation like CPI, WPI, wholesale price index, consumer price index, showing your true purchasing power. So real yield shows the true purchasing power. Then we have the net yield. Net yield means it takes into account tax deduction, showing the investor take home return. Then we have the current yield. How to go about finding the current yield? Coupon multiplied by face value divided by market price. That is called current yield. Coupon multiplied by face value divided by market price is called current yield. Current yield gives the return at the current market price. Then we have the redemption yield or YTM. The yield you earn if you buy the security at par value and hold until maturity. Then we have the RBI Public Debt Management, PDM. So RBI ensures smooth functioning of the debt market and control liquidity in the banking system. So then we have underwriting. Underwriting, RBI guaranteed unsubscribed government security. OMO, open market operation. RBI buy or sell security to regulate liquidity and interest rate. Then we have CRR and SLR enforcement. They control the cash flow in the bank, ensure financial stability. So CRR is that bank must hold a certain percentage of the NDTL, that is net demand and time liability, as a cash with RBI. That is called cash reserve ratio. SLR means a statutory liquidity ratio, which means bank must maintain a certain percentage of NDTL in cash, gold, approved security, up to 40% of their DTL. Right, that is the rule. So yield help investor understand return from government security, while RBI manage public debt through CRR, SLR, open market operation. Now friends, let's understand financial market and how bank manage their liability and asset. Gilt edge market, already I told you, this market trade the government security which are risk free, highly liquid, offer guaranteed return. Then I told you about the OTC market, a decentralized market for stock, commodities, currencies, trade happen electronically. Right, some rate I provided you. Repo rate is the RBI lend money to the bank when they face shortage. That's the rate at which the RBI lend money to the bank is called repo rate. It help control inflation. Reverse repo means RBI borrow from bank. Higher reverse repo rate reduces liquidity in the system. Bank rate means what? Unsecured loan from RBI to bank. RBI give unsecured loan to the bank, which is quite different from repo rate. And OMO means open market operation, which means RBI buy or sell security bills, say treasury bills, right? RBI buy or sell the treasury bill and government security to regulate the money supply. If you look at the bank liability, so bank collect deposits and lend money to generate profit. So their liability are divided into demand liability, which means DL, which are payable on demand, like current deposit, saving, overdue term deposit. Then we have the TL. TL means time liability. So these are the non-demand fund, like fixed deposit, recurring deposit, cumulative deposit. Then we have other demand and time liability. They are miscellaneous, like accrued interest, unpaid dividend, bill payable, participation certificate. Then we have the banking system asset. Bank use their fund to lend or invest in current or other account balance, short-term loan and deposit, which are repayable within 15 days. Other long non-short-term loan in the banking system. This help a bank earn profit while maintaining the liquidity. So to summarize, we can say that financial market provide investment and liquidity channel, while bank manage liability and asset to balance profitability and stability. Let's talk about the global treasury and foreign exchange. We will learn about global treasury management and foreign exchange operation. We have something called international fund management. Global treasury manage fund in multiple currency. It ensure cross-border operation are smooth, whether for trade, investment or payment. If we talk about the currency conversion mechanism, it convert income or wealth from one currency to another. What are the methods used? Direct exchange, check and draft, telegraphic transfer, bill of exchange, trade bill, promissory note. These mechanisms help business settle international transaction efficiently. Right. What about the authorized dealer? Bank and a specialized agency approved by the central bank. They facilitate foreign exchange transaction for individual as well as the company. Authorized dealer ensure regulatory compliance and secure conversion. Then we have the forex market. The foreign exchange market is the backbone of global finance. They enable currency conversion for international trade, investment and payment. Without a forex market, cross-border commerce would face many hurdles. So we can conclude that in short, global treasury manage fund across currency, authorized dealer handle foreign exchange transaction, and the forex market ensure that world economy keep moving smoothly. Now friends, let's switch our focus to how the foreign exchange operation works. So currency demand driver. So demand for foreign currency come from import, export, individual foreign exchanges, and the business trading internationally, they need forex to meet their obligations. Central bank regulate all the kind of forex operation to ensure compliance with the rule. What's the meaning of trade surplus? It means excess foreign currency available. Net importer, they may face currency shortage, right? Scarcity leads to strict foreign regulation, right? Countries with higher trade to GDP ratio, they have more public attention on the forex rule. Globalization make forex transaction a core part of the treasury management. This question may be asked. Forex transaction is a core part of the treasury management, not the dual role transaction. Every transaction involve buying one currency and selling another, right? This every forex transaction involve in one currency we are buying, other currency we are selling, right? And immediate currency release. So for travel and urgent foreign payment we require immediate currency release. Then we have TT, telegraphic transfer, fast, same day, secure with optimal rules. Then we have mail transfer. This is slower, cheaper but delayed payment. But delayed payment may affect interest and rate. What about the financial instrument in forex? You know it very well, that bank draft. So payable order sent to the branches or correspondent bank abroad, that's called bank draft. And paid on site, but transit delay and risk can affect the timing and interest. So to conclude, we can say that foreign exchange operations are driven by trade and individual needs. Central bank regulate the function. Now let's talk about the foreign instrument and market operation. What are the some instrument available? Like the first one, we have bill of exchange. It is a written instruction to pay a specific amount. Types of bill can be side bill, which means payment is immediate. Usance bill, which means payment is after a due date or a set period. Categories we have bankers bill and trade bill. Bankers bill are drawn on bank. Trade bill are drawn between individual or business. Please note it down. Right, two categories are there: bankers bill and trade bill. Bankers bill are drawn on bank. Trade bill are drawn between the individual or business. If you look at the forex market segment, so the forex market operate at the multiple level. First of all, we have the bank public transaction, interbank trade, overseas branches and correspondent, RBI dealing. So this forex market, most transactions are non-physical. Non-physical means they are done through the credit instrument or digital entry with cash playing the minimal role. If you look at the spot and forward transaction, so spot transaction, what happen? Currency is exchanged immediately. Forward transaction, what happen? That currency exchange is deferred to a future date to align with the payment schedule. Now, what is the importer strategy? They use a spot for immediate payment and they use forward contract to plan for future obligation. If you look at the forward transaction and arbitrage, so forward agreement are the pre-agreed rate for currency exchange in the future. And forward rate influence is that domestic and international interest rate and currency strength are influenced. Right. If you look at the risk, see, forward rate may deviate from future spot rate, causing potential financial loss. So to summarize, we can say forex instrument like bill of exchange, spot forward transaction, they help business manage international payment efficiently. You can see the role of forex in the case of treasury. You can see they are the inseparable part. Now, what kind of risk are there? You can see forex risk, which includes credit risk. Credit risk means that the possibility that the foreign borrower may not repay the loan. Then the second risk we have is the currency volatility. Means exchange rate fluctuate constantly. It will obviously create uncertainty. Then we have the country risk. Country risk means what? Political or economic instability in a country. It can increase the loss. Then we have the solvency issue. This means this is like a mismatch between the assets and liability. This can cause default. If you look at the authorized bank in India, so commercial and cooperative bank are authorized to conduct forex transaction. They facilitate international trade financing and a smooth cross-border payment. If you look at the currency management, you know it very well that bank balance currency demand and supply using their reserves. Yes, bank have reserves and using those reserves, they can balance supply and demand. RBI intervene. How RBI intervene? By buying or selling currency to maintain the market equilibrium. So market equilibrium should be maintained. Supply and demand should be equal. And if they are unequal, then RBI intervene. Either they buy or they sell the currency. If you look at the daily operation, this is called position tracking. So bank maintain daily sheet for each currency, tracking purchase, tracking sale. And unbalanced position are covered to avoid the exchange rate loss. Overbought or oversold position, they are adjusted through currency sale or currency purchase. If you look at the forex dealer structure, major banks supervise branches dealing with forex, right? And dedicated dealing room and back office team handle day-to-day forex operation. So to summarize, we can say that bank face multiple forex risk, but with proper tracking, risk management, RBI support, they ensure a smooth international transaction. Now, dealing room and back office function, very, very important. So we will explore how bank manage forex operation through dealing room and back office. If you look at the dealing room function, first one is the exchange rate negotiation. So it set straight for a large foreign currency transaction. Risk coverage, which means balance purchase and sell to minimize the currency fluctuation risk. Proprietary trading, which means trade currency using the bank owned fund to earn profit. Currency funding, secure fund via swap or dealer purchase. And then we have forward contract management. It handle customer forward contract for future currency need. If you look at the back office function, we have consolidation. You compile all the forex transaction and manage cover operation. Deal analysis, which means assess the deal and predict future exchange rate. Fund transfer, which means one more point is that interbank processing, which means issue or receiving contract notes to confirm the transaction. Fund transfer means they monitors the transfer into the branches or correspondent bank for contract fulfillment. If you look at the GDP, so GDP is the total monetary value of goods and service produced in a country, and this is the key indicator of economic health and growth trend. So to summarize, dealing room manage active trading and risk coverage, back office handle confirmation and fund transfer. Please note it down. Dealing room manage active trade and risk coverage, back office handle the confirmation and fund transfer, and GDP help in understanding the overall economic performance of a country. Then we have financial instrument. Yes, there are some instrument here, like we will simplify some financial instrument like the swap. Swap. Swap is an exchange of financial instrument at a pre-agreed future date. Right, exchange of financial instrument at a pre-agreed future date. Friends, we will break down what is the meaning of corporate finance function and treasury management. So corporate finance, it ensures that company has a strong financial stability, right? And one more point is the investment management, which means they allocate fund strategically to maximize the shareholder value. If we talk about the fund utilization, so we can see that they avoid any idle fund, they prevent liquidity shortage. We are talking about corporate finance, right? And financing decision, we can raise fund cost effectively and at the right time. Then we have funding strategy. We can balance internal equity, we can balance external borrowing, keeping in mind cost of capital as well as the return. Now, what are the financial and treasury management role? So finance manager, he align investment and financing with the company capital structure. And fund management, they can source fund strategically to meet the business need. What about solvency focus? Solvency ensure that company can meet the short and long term obligation. Profitability goal is to maintain sustainable profit and adequate return on capital. And treasury operation is to manage the daily cash flow to keep the operation smooth. Treasury role and finance management role, I already told you. Treasury role is to support the finance by efficiently managing operational fund in line with the business objective. So in short, finance focus on strategy and planning while treasury focus on day-to-day cash management. Right. So conclusion is that corporate finance and treasury management work hand in hand. They work together. Finance ensure that company grows strategically and treasury keep the daily operation funded and smooth. That is how they work hand in hand. That is the corporate financing. Now we will explore how finance and treasury function complement each other. I told you now, treasury refine financial strategy and handle day-to-day operation and cross integration. Treasury work closely with manufacturing, marketing, other department to create synergy. And they manage money, forex, government security to optimize the fund. That is called integration of these three things. On one side we have money market, forex market, as government securities. The objective is very simple, right? Financial management objective is to plan capital investment, plan profit budget, plan sale forecast and control the cost. And the objective of the treasury management is to execute this plan by managing the short-term fund. If you look at the finance and treasury responsibility, first point we have fund oversight. Finance raises fund and treasury manage the daily utilization. Who raise fund? Finance raise fund. Who manage the daily utilization? Treasury manage it. Financial reporting means finance prepare profit and loss, balance sheet. They handle taxes, audit and budget. While treasury monitoring, they track the income, they track the expense budget, they perform variance analysis and support internal audit. If you look at the strategic and long-term focus, so finance develop long-term strategy for investment and financing. While success metric, they measure performance by reducing the project break-even time and improving the return. So in short, we can say that finance plan and strategize while treasury execute and monitors. Together they ensure that companies stay profitable, liquid and financially stable. Now treasury and finance strategy. So friends, treasury is just for short term. They design the accounting system and control report to manage daily operation. Liquidity management means we ensure smooth cash flow, manage payment and accelerate concern. So we are talking about the roles which is placed by the treasury and finance. So third role is the finance manager, which is for long term. Treasury is for short term, finance manager is things about the long term. They monitor the fixed asset in line with the project duration. Then we have asset upgradation. So review this treasury and finance, they review the asset for depreciation. They decide on upgrade or replacement. Now current asset, if we talk to the context of current asset, so treasury manage net current asset like inventory, receivable and cash. And asset quality, they means we have to maintain SQLA, high quality current asset, to ensure a strong liquidity. To the context of investment, finance focus on long-term investment. Again and again I'm repeating. Long-term investment finance, short-term investment treasury. Right. Now treasury organization structure. You know it very well that depends on the service range and management centralization. So the treasury organization structure focus on asset liability management. That's called ALM. Then we have ALM role. So ALM role is to manage maturity, interest rate, currency mismatch. And if you talk about the sales and trading, so deals in forex, money market, credit and derivative. Risk management, handle back office operation, settlement, accounting and regulatory reporting. So in short, we can say finance manage long-term strategy, treasury ensure daily liquidity and operational efficiency and long-term short-term investment. Together they maintain a stable, profitable, risk managed financial system. Let's talk about the organization flexibility. So there's something called treasury adapt to the company need, from simple liquidity management to full financial service. Look at the treasury organization model. First of all, we have operational flexibility, which means tasks can be outsourced, tasks can be handled in-house based on the strategy. Centralization means, centralized means back office control and supervision. Decentralized means front office decision making near operation, right? That is called centralization and decentralized. In the case of centralized, we have the back office, that is their role placed by centralized, back office control. Decentralized means front office decision. Then we have a unified risk approach, which means that central strategy, local implementation. Full service global model, which means centralized control with unified policies for global operation. Then we have full service local model, independent regional unit cover serving the local need. Limited service global model, which means smaller treasury activity managed directly by the business unit. If you look at the role of treasury manager, cash flow coordination, which means aligning the inflow, aligning the outflow to prevent the fund shortage. Routine but critical. So manager essential daily operation to ensure that solvency and profitability. Accounting system, cross department support, budget override. These are all the role of the treasury manager. So in short, we can say a flexible treasury structure ensure that company adapt to the changing financial need, while treasury manager keep daily operation smooth, cash flow stable, and department coordinated. Some more responsibility they have mentioned, like regulatory compliance, right, which means designing system and process that follow legal and tax regulation. Impartial support, which means they manage the expenditure request fairly, that is the role of treasury manager. Crisis leadership and networking. So these are the things. Now integrated treasury, I told you now. So we will discuss integrated treasury. Integrated treasury includes holistic financial strategy, which means managing the bank balance sheet, allocating resource across domestic and international money market. So our aim is to enhance the overall financial efficiency. Optimize asset liability management. It balances our asset and liability. Why? To maximize the return. So there is something called arbitrage opportunity. We identify those arbitrage opportunity to improve the profit. Then we have evolution from the traditional operation. So Forex dealing room, they handle merchant and interbank transaction, and domestic treasury, they manage investment and reserve as independent cost center. Shift to integration. Earlier, they were working in a standalone manner, right? So they are the three part. Money market operation, this was separate. Then our forex operation, this was separate, and the third was our so all of treasury was working separately. But there are some factors which cause this unification. What are the factors? Like interest rate deregulation. Then we have recognize relaxed exchange control, forex market growth, derivative, technology, right? So because of all this shift toward integration was there. Okay, forex dealing room were working separately, ALM department working separately. Now expanded treasury role now goes beyond the forex and investment. It includes advanced reserve management, strategic financial function. So we have talked just now that integrated treasury combine traditional and modern practice, optimizing cash, reserves, and investment. If you look at the key treasury function, so first of all, reserve management, which ensure compliance with the CRR and SLR, keep the bank liquid and safe as per the regulatory norms. Second is the portfolio optimization, which means we balance our investment for return maximization. We align our investment duration with the financial goal. First of all, we have a goal. Similarly, we align our investment duration accordingly, and we conduct duration analysis. Why? To manage interest rate risk. Yes, to manage interest rate risk, we conduct duration analysis. Then we have cash flow and liquidity oversight. We track what are the measures inflow, what are the major outflow from ALM activity. And then we build a diversified and a stable funding base. We advise on funding structure, what are the currency mix, loan tenor, cost, expected return. Then we have ALM. So ALM means we decide the ideal size and growth of the balance sheet. That is called balance sheet optimization. We price assets and liabilities strategically while staying with the regulations. Then we have market risk mitigation. So basically what it does, interest rate fluctuation and ALM mismatch. These are managed by our integrated treasury. We address the asset risk like disintermediation, securitization, credit derivative. These are the risks which are faced by asset. We monitor the cash flow impact. So what will be the impact on cash flow due to the change in the price of the asset? We monitor that and ensure compliance with the exposure limit. Transfer pricing, I think we have discussed it already, that it balances yield and liquidity to maximize return, right? That is transfer pricing. And we use some insight from funding needs and access to money, capital, forex, credit market. Strategic rate setting. We set the benchmark rate for business unit as well as product. It takes market risk into account to guide effective strategy. We developed some product like IRS. IRS is called, interest rate swap, and cross currency derivative is developed to hedge the exposure. We perform the low risk arbitrage. Now the focus is on to prioritize the high quality asset and to monitor the ROA. What is ROA? Return on asset. It operates like a profit center. Very, very important thing. Treasury operates like a profit center, including proprietary trading. Then it combines forex and domestic treasury unit. That's called geographical and infrastructural. Horizontal, it aligns trading unit under the unified policy, hierarchy and system. And vertical means centralize the control over trading and arbitrage. Furthermore, we have enhanced financial performance, which means increased portfolio profitability. It combines banking and trading asset, optimize fund utilization, liability sourcing. So in short, we can say, treasury ensure smart fund allocation, risk management, strategic trading, etc. Now friends, we have, in this segment we will explore how treasury improve our operational efficiency, how it manages risk proactively and structure the operation for maximum profitability. So treasury enable real-time offline data sharing. It provides a single point of service for the customer. It strengthens our internal control, management information system, regulatory compliance. We have proactive profit and risk management. So this treasury, it acts like a hub for arbitrage and hedging, maximizing return on currency portfolio. And if we talk about the organization structure, so these are the three office: front office, mid office and back office. So front office, what happen? That dealers and trader execute transaction and spot arbitrage opportunity. Mid office monitor, analyze and report risk to the top management. And back office support transaction processing, ensure compliance, conduct audit. Front, dealer and traders. Mid, monitor, analyze and report risk to the top management. And back office support transaction processing. So remember, these are the very, very important thing. Okay, so question may be asked, what are the functions performed by the back office? Please remember, accounting, settlement, reconciliation, these are handled by the back office. They ensure that enough accurate record is there, adherence to procedure is there, and they conduct independent daily review audits, right? Maintain operational integrity. Arbitrage opportunity is always there, which means profit from price difference in different market, right? This is a chance which is present everywhere. Then we have market and arbitrage insight. So in highly efficient market, asset price and exchange rate were well aligned. This reduces the scope for arbitrage opportunity. So if you have a highly efficient market, there is a low scope for arbitrage. And Indian bank uses integrated treasury operation with advanced tools like router, Bloomberg, hotlines, dealing board, etc., etc. So that is all we need to learn from this particular chapter. I request you to please go through the video once, and if you want such kind of PDF, you can WhatsApp me on this particular video in particular number, and I will bring the module B, module C, module D lectures also, so that you can quickly revise the key points.